CD number 1, Introduction to Stocks and Stock Options Trading. Welcome to the Optionetics course CD audio series. These CDs make up the audio component of the Optionetics Home Study course. Taped at a live seminar in San Francisco, this series is designed to increase your understanding of delta-neutral trading, as well as introduce you to managed risk trading strategies. Optionetics is defined as the science of high-profit, low-stress trading and is designed to provide traders with a comprehensive approach to integrating the use of options into your personal trading approach. To get the most out of these CDs, it can be beneficial to listen to them repeatedly until you are completely comfortable with the material. The audio portion of this course will enable you to increase your trading know-how at your own pace while developing trader confidence, one of the primary keys to becoming a successful options trader. In the first CD, we are initially introduced to Richard Kaywood. As CEO of Optionetics, Mr. Kaywood has witnessed the development of Optionetics as a business since the company's fledgling seminar in 1993. Since that time, Optionetics has expanded its operations all over the world. Mr. Kaywood goes on to speak about how the techniques taught in the Optionetics course can be used to manage risk, one of the most important factors of successful trading, especially in today's volatile markets. For the record, Mr. Kaywood affirms that Optionetics is not in the business of giving investment advice. That is something you receive from your broker. Optionetics is designed to teach you how to trade using options. In addition, you're officially invited to re-attend seminars in order to refine your trading techniques. The rest of the CD features a review of option basics by super trader George Fontanills. George pioneered the Optionetics approach to trading after graduating from New York University and receiving his MBA from Harvard Business School. A lifelong entrepreneur, George made his first fortune in real estate before turning to the markets for his next venture. George has traded on the American Stock Exchange with floor operations in the Chicago futures markets, where he gained extensive knowledge in trading futures, stocks, and options. After a comprehensive analysis of the fundamental approaches used by other floor traders, George Fontanills developed a unique approach to trading using delta-neutral, low-risk option strategies. Calling this approach Optionetics, George became the first professional trader to bring his enhanced concept of delta-neutral trading to the everyday trader in an easy-to-understand and comprehensive format. His time-tested, high-profit, low-risk trading strategies have garnered George a reputation as a dynamic instructor, best-selling author, and master trader. And now, here's Richard Kaywood and George Fontanills.
Congratulations on your purchase of Optionetics. My name is Richard Kaywood, and I am the company's CEO. I wanted to take a minute to welcome you to our organization, give you a little background about us, and to explain some of the benefits you now have by becoming our student. Optionetics was started in 1993 by George Fontanills while he was a principal of a floor trading operation on the American Stock Exchange. While there, George developed and refined successful strategies that could be used by individual investors. He named his strategies Optionetics. Optionetics is the science of high-profit, low-risk trading strategies. From these humble beginnings, we have grown to a financial publishing company spanning the globe, teaching people around the world how to trade correctly. We are proud to be celebrating our 10-year anniversary. We have been featured in leading financial publications such as the Wall Street Journal and Barron's, and on the television on CNBC, Bloomberg, and Reuters. Our commentary can also be found on the internet, on such sites as Yahoo, TheStreet.com, and Lycos, to name a few. While not providing individual investment advice, we concentrate on educating you on managing the risks of your trading. By taking the Optionetics course, you have become a member of our Lifetime Trader program, like thousands of alumni in the United States and around the world. As an Optionetics Lifetime Trader, you will enjoy numerous benefits, including our most popular benefit, lifetime free education, the ability to re-attend future Optionetics 2-day seminars for free anywhere in the world. Since 1993, our alumni have used this benefit to learn how to trade Optionetics in up, down, or sideways markets, and also enabling them to learn our latest strategies for free, taught to you by our professional trading team. and to refine their trading using our strategy coaching provided by our traders. Again, congratulations on joining the Optionetics family.
All right. Thank you, Richard. Let's take a survey. Here's the market. This is what the Dow Jones Industrial has been doing recently. As you can see, it doesn't look real pretty, does it? All right, let's take a survey. Tomorrow, is the market going up, down, or sideways? Okay, let's say, okay, how many of you think the market's going up tomorrow? Up. You're willing to bet all your money on this? Okay. No? Okay. How many of you think it's going down tomorrow? Okay, which is about 90% of the class. How many of you think it's going sideways? Okay, so if 90% of the class think it's going down, it's probably going up, right? Is that the... Okay. How about over the next, let's change the time frame. How about over the next year? Up. How many think it's going to go up from here? Well, that's changed a lot, hasn't it? It's about 80% of the class. How many people think it's going down? Okay, maybe 15, 20%. How about sideways? Okay, so that's a small percentage. So basically, a lot of you think you're more bullish for the long run, but bearish for the short term. Why is the market doing this? Somebody give me some answers as to why this is happening. What causes markets to do this? Uncertainty, isn't that right? This is confusion. The one thing I can tell you is going to happen in the markets is you're going to get a lot of volatility. How many believe that? Okay. For those of you who've never traded an option, how many of you have never traded an option? Raise your hand high, please. Never traded an option. Okay, that's important for us to know. So it's a good number of people in here. How many of you have been trading the last year? Okay, 5 years? 5 years? 10 years? Okay, a few people have done 10 years and stuff. I've been trading basically 14 years, just so you know. These markets that you see today are the best markets I've ever seen for what we do. Okay? For what we do. Okay, that's what I'm saying. This is the best I have ever seen, and it's hard to believe. I mean, with the markets, with a lot of people losing so much money, we're sitting around clapping, which is it seems kind of strange. You're sitting there watching the Dow down 400 points, and we're saying, go baby, go baby, go baby. And I sat next to a guy yesterday on a plane, and he's just terrified of the markets. And people right now are just getting out at no cost. How many of you have exited your stock positions? All right, any of you just said, I can't take this anymore? I've been telling people for 10 years, don't trade stocks. They're too risky. A few people believe me more now. Let me just show you the view from my office in Miami when I'm trading. This is what it looks like in Miami. Okay, that's a true view from my office, beautiful blue waters, whatever. This is the view for most people who are trading. Look at Tom and I are having a contest. Who's going to have the best jokes in 2 days? So I figured I'd have to start early, but I thought that was a funny one to show people. But the bottom line is, when we're out there trading, what you guys have to do is realize, don't be scared of these markets. These are very exciting markets for options traders. And the volatility being as high as it is, as tremendous as it is going to scare most people, but an option trader loves this stuff. Okay, so what we're going to do during the first session, we're going to go through the basics of why we do this stuff. All right, most important thing is for you to get the basic principles of everything that we do. Here's the most important thing, is we can make money no matter what the direction of the market is. How many of you have made money because the market is going down right now? Anybody here doing that? Okay. How many of you are still trying to be bullish this market and trying to fight the trend? Anybody here really seriously still trying to fight the trend? I see this all the time. I mean, I sit when I'm flying around and people say, what do you do for a living? I just say, I'm in the stock market. I mean, that's all I tell people. And they're like, oh, poor you, right? Because you don't want to explain, I'm an options trader, I do this, and then I have to go through like a 2-hour course on trading options. This guy yesterday, you're in the stock market. How you doing? I go, I'm doing okay. And he's like, so you're buying stocks and making money? No, I'm making it on the downside. And it just couldn't understand what he meant about how do you do that? And then I finally said, look, I trade options. And most people think options are what? Risky. Okay, so let's think about what are the reasons most people do not want to trade options. Too risky. Anybody in here still have that view? Anybody in here? You can be honest with me. This is like the Church of Optionetics here. This is Sunday. You're here to get rid of your sins, you know. So, you know, for 10 years, for over 10 years, when we've been interviewed by the Wall Street Journal and all the other publications, we tell them that stocks are too risky, not options. The reason we think stock, you're going to see why that's the case. You know, most people think options are too risky, but the reason they say that is because they don't have something called the knowledge. Isn't it easy to say something is risky if you don't understand it? Okay. How many of your brokers do you think really understand options? A few. Very, very, very few. Over the last few years, more brokers are starting to understand options. But over the years, certainly over the last 10 years, if I had to say how many brokers understand options, 1% or less, which is a small percentage because they're not going to college, they're not going through their education process at a brokerage firm to understand options trading. So the best thing is they're going to say, client calls up and says, I want to trade options. What are they going to say? Oh, why do you want to do that? You're going to lose all your money. And what you should tell them now is, I've already lost all my money with you anyway. So, so why should I listen to you? You know, I've been saying, well, for 10 years, I've been saying brokers make you broker. You know, it's funny how after 10 years now with the markets doing what's happening here, people are now saying, well, maybe brokers don't understand what they're doing, right? And we've been making jokes about this for a long period of time. So people say it's too risky, they don't have the knowledge, you have to work too hard at it, which I disagree. And stocks are safe because the SEC allows you to trade stocks, right? But the bottom line is when you're trading stocks, I think let's put it this way. In the last 10 years, I might have bought 3 or 4 stocks over this whole period, over the thousands and thousands of trades I've done. And the stocks that I'm typically buying are the ones that don't have options, and number 2 are the ones that can't hurt me. Stocks that can't hurt you are trading like at 0 or 25 cents, right? I mean, everything else can hurt you. How about Enron? Anybody here get hurt by Enron? We were in Houston doing a seminar with Enron, and I love finding out what the biggest companies are in the area. I asked people, how many of you are in Enron? I think we had about 4 people who worked for Enron. The stock was very high at that price, very high. I forgot what the number was, but it was a very high price stock. And I said, no matter what you think about that company, everything can go down. Everything can go to 0. Like Enron can't go to 0. It's the best company in Houston. And you know what happened? The people who hedged themselves, they now can retire, versus the people who didn't hedge themselves cannot retire. Okay? And that's one of the sad things that we see in this world, is that a lot of people lost a lot of money in the market and now have to work even longer. Okay? Which is a horrible concept. You know, the concept of even working for anybody is a horrible concept. You know, I lasted 30 days in a real job. And that's a true story. I got fired for a bad attitude. This is a true story. My boss calls me and he says, George, you have a bad attitude. I said, what do you mean? He's like, you don't like to come to work. And I said, does anybody? that job, I had to get good at something, so at least I got good at something profitable. But anyways, what I want you to realize is the markets are going to turn around at some point, and you want to be positioned for that, but it's going to be a longer-term play. Can I put on options positions that are going to benefit from that? Yes. Can I put on options positions that, given the market being so crazy today, can make me money? Yes. Can I make money if the market goes sideways? Yes. So basically what you need to do is create a tool chest, let's call it, of different strategies, which is what we're going to give you. You're fortunate that you have Tom and I together in the same room. Rarely that occurs anymore, just because we have so many seminars, as you know, around the world going on right now. And I only come to a few of them, and San Fran is always obviously one of my fun ones to come to. So what I want you to realize, for those of you who, first of all, have never seen us before, no one knows this stuff better than us. No one. I'm talking about any other person teaching options. I'm talking about Wall Street trading firms. I'm talking about anybody you ever meet. We know this stuff backwards and forwards. And what you need to do is get your education level up as fast as possible. My promise to you is that in 2 days, you will learn as much as I learned in my first 7 years. So you're going to go up a learning curve that probably took me 7 years and millions of dollars. So you're going to learn a lot faster than I ever did. I've been doing this 14 years, so 7 years from now, you should be an incredible trader. I mean, I'm telling you, incredible if you can go up the learning curve as fast as I did. Why did I get good at this? Because I got kicked in the head so much, and I never gave up. Honestly, that's what it was. I just said to myself, no matter what happens, I have to get good at this because no one's going to hire me ever again. So, and I cannot work for somebody. So the bottom line is I had to get good at something, and I said no matter what the markets do to me, you can kick me in the head over and over again, I'm just going to get up, kind of like that punching bag. Remember that punching bag? You punch, it goes down, it comes up. I said, I don't care. I don't care if I'm a Harvard MBA, I don't care if you're a high school dropout. The markets are the greatest equalizer of education, just so you know. I don't care if you're sitting here, you're a rocket scientist from NASA, and I don't care if you're sitting next to someone who's a high school dropout. It's totally irrelevant in the markets, which is great for everybody. So Harvard Business School did not teach me this stuff. In fact, if I listened to a lot of the stuff they did there, then I probably wouldn't be making any money. What I realize is that people who go out there and they persevere and they go through and they fight until they figure it out and never give up because they eventually want to do this for a living, that's the best thing in the world. You guys are trying to train yourself, and you have to understand that you're going through a college now. In 2 days, you're going to go through an MBA course in options trading. You're going to get a lot of information. Like I said, you're going to get 7 years of information. You're going to have more information than many professional floor traders even understand. And we're going to show you the differences of, being someone like you who's an off-floor, quote, off-floor trader versus the professional floor trader. And I want you to understand that you are going to sit here. A lot of you are going to say, like, wow, that's a lot of information. But that's why we allow you to come back to all the classes for free, as long as you want. I've met people who came to the very first seminar I ever did in Las Vegas a long time ago. And, we build a good camaraderie. We build a lot of friendships, through the years of coming out and doing this for many years. It's actually a lot of fun to come out here and do this, and it keeps us in touch with the people. We get to come down and see how everybody's doing, etc. I'm fortunate enough that this company has grown substantially, and I don't have to spend any time doing it. Basically, I get a ticket that says, George, go teach this class. Other than that, I don't really have to do much else because, I'm sitting in front of computers trading day in and day out. And the beauty of that is we are basically a research and development team. If we create something new that makes us money, we don't hold it back because I am not creating competitors here. If I make you a successful trader, you're going to have more options volume. If there's more options volume, I can trade even more. And honestly, if everybody here became a great trader, it'd just be a fantastic thing. Because there's going to be enough people out there who don't know what they're doing, okay? And they deserve to give their money to us. That should be your policy. And it's just, let me tell you, there'll be so many people out there, you don't have to worry about that ever happening. And, I've had that question for 10 years now. Well, if we make everybody successful, then, are you going to hurt yourself? I'm not hurting myself. The options market are fantastic markets. They're big enough for everybody to play. And, you'll see they're going to get bigger and they're going to get bigger and they're going to get bigger. And most importantly, what you guys don't see is that you guys now have the advantage being an off-floor trader. You guys are called what's off-floor traders than the floor traders on the floor of the exchanges. You have more information, you have more knowledge, you can see more things than the typical floor trader does. And that's why a lot of the exchanges, a lot of the options exchanges are having a lot of trouble. Because you guys are winning the battle, it's not the floor trader anymore. And I'm going to explain what the floor trader does versus what you guys do. So for those of you who've sitting here for the first time, and I know those people sitting here saying, oh, is this for me, is this for me, oh, I don't know, why did I pay so much money to come here? You're going to get a ridiculous amount of information and ridiculous amount of value of that. Honestly, if I had to charge you what I think this class is worth, I'd charge you $1 million. Because you can make that. You can make a lot more than that. And that's the reality of it, because it cost me a lot more than $1 million to get to the point what you're going to learn in 2 days. So once again, I want you to understand that markets go in 3 directions. You can make money no matter what happens. When the market is breaking down the way it's doing now, it's an unbelievable opportunity for you guys. And I want you to understand that dearly, because I know a lot of people don't understand that. Okay. Why trade options? Most importantly, you can have lower risk than buying a stock. If you gave me $10,000 today and you said, George, put it in Intel. Isn't Intel out here? Okay. You know, I was driving down the street the other day, and it's unbelievable. I'm looking at all these buildings with companies that are just out of business with the name on top, right? And I'm just sitting there saying, I remember that company. I remember that company. I remember that company. It's just unbelievable that what happened years ago with the internet craze, what's happening now because people have lost a lot of confidence. Stocks, trading stocks, just drive you nuts. They can drive you crazy. In fact, I was looking today, which I like to do at all the publications I have at the hotel here, and I was looking at a publication called Mutual Funds. So I wanted to go see what the top 100 funds were doing. There is not one green arrow here, okay? They're all red arrows, meaning they're all down. And we're talking about 19, 15%, 18%, 17%, 20%, 13%, 20%, 20%, 34%, 35%, 29%, 17%. That is some bad performance, guys, okay? You know, unless you're a glutton for punishment, you do not like these numbers. I mean, there's really virtually not one red arrow on this thing. And it's kind of interesting. I really never even looked at that, but it's depressing, isn't it? How many of you are depressed about your mutual fund performance? Okay? Well, you know what? That's the reason is because most mutual funds cannot short stocks. They have to buy stocks, okay? And in an environment like this, is it easy to find stocks that go up? Absolutely not. To find a stock that goes up, let me tell you, if you made me manage a mutual fund, I bet my performance wouldn't be any better than this. Because if my only choice was to buy stocks in a market that's falling apart, what can you do? There's very little going up. So therefore, the trick for a mutual fund investor now is to get out as fast as they can, right? And it's not easy when you're trading millions of shares of stock. And that's one thing you have to realize. So mutual funds are at a severe disadvantage compared to, say, you guys or what's called a hedge fund. A hedge fund is just a partnership of money that can short things too. So what you guys have an ability to do, and if you're in mutual funds that you don't plan to get out of, you better start taking some bearish positions to kind of offset the risk. And when the internet stocks were going straight up, we were telling people specifically, this market, when it falls, will fall like a rock. And people are like, how do you know that? It's a new world, a new paradigm. You don't have to make money for the stock to go up. Remember that? You can put .com behind your name and you become a billionaire. And I just said, you know what goes up will come down, and it comes down faster than it goes up, okay? So buying stocks to me is a no-no. I'm going to show you tomorrow how to do a no-risk way to own a stock. If you own stock and you want to stay in it for tax reasons, or you just love the stock, or you just want to own it, I'll show you how to protect it and still make a very good return on your money. That's one of the things that we'll show you tomorrow called a collar. It's a no-risk trade used by the best institutional investors if they understand what we're talking about. Then I'm going to show you ways to even do better. So there's some new products coming out. They're going to come out hopefully pretty soon. That the potential is to make 100% on your money risk-free. How many people would like to learn how to do that? Okay. Well, I'll show you how to do that. There's some new products coming out that I'm going to show you some fantastic strategy tomorrow once you get through the learning curve. On how to do it. By the end of the day tomorrow, you're going to be smarter than most people out there. In fact, we've written a lot of articles out there. We've been in a lot of publications, and you're going to realize even the big publications do not understand what we do. The Wall Street Journal sat through this class. We've had a number of Fortune magazines sat through this class. And the good thing is they understand that options are an important part of the business, and they just need to understand more. So hopefully what you're going to understand by the time we're done this morning is that stocks are risky. There's always a better thing to do than own stocks. So you give me $10,000, my last choice ever is to buy the stock. In fact, I won't even buy the stock. In fact, I might as well just go to Las Vegas and stick it on a table, because it's probably the same chances I have of making money. I probably have a better chance making money that way than buying a stock, given what the markets are doing these days. So you're going to lower your risk, we're going to lower your cost. What I mean by that is that $10,000 in buying stocks cannot give you any leverage. Leverage is an important concept, because if you can take lower risk and put less money up, is that usually a good thing? Yes, yes. Shake your head. Yes, yes. Okay. We need confirmation. Okay. You know the little puppy you put on your dog, your car? Yeah, that's good. Okay, here's the third thing. Options allow you to be more creative. When you buy a stock, you can only buy a stock and sell a stock. Now, creativity may scare a few of you, but it's really not going to be that hard. Basically, what we're saying here is that you're going to be able to create whatever picture you want of what you want your stock to look like. For example, as you see over a 2-day period, every trade I do has a picture created to it. Just like I just bought a new car the other day, you know, I walked in, don't you want to look at the car? Don't you want to test drive the car? Don't you want to look at other cars? Don't you want to maybe compare it to another, another automobile? Well, you know what? Before I made, a large purchase decision, I wanted to look at what I was going to do. Where most of you or most people in the markets have no idea what the picture is that they've created. And you're going to understand what we mean by that. So to me, trading is just a picture. I look at a picture, I like it, I do the trade. I don't like it, what do you do next? What do you do? If you don't like the picture, you pass or find another picture, just like a car. You don't like your car, they just drove up, it's a hot pink, whatever, Ferrari. And you're like, I don't like that car, Well, you know what, get me a red one, get me a black one or whatever. That's kind of what we do. We just manipulate things or change the things until we get what we really like, all right? And if we cannot create a picture that we like, what do? You just pass. There's nothing wrong with passing on a trade. No one's putting a gun to your head saying, you have to trade today, okay? Which is a beautiful thing because we can sit there, we can decide when our opportunity is there, we can decide when opportunities are not there, and this allows me to do what I want to do, and no one can force me to trade. I can be aggressive, I can be not so aggressive. I mean, you're going to see systems here over the last, strategies and systems over the next 2 days that can be aggressive or not aggressive. I have a group of students who, they don't want to trade short term. I have a group of students who want to trade short term. And it depends on your personality. So what we're going to try to do is match your personality to the strategies that you like. When you match that personality to the strategy you like, you're going to be more successful. Don't you think that if you're comfortable with the process, you'll be more successful? Well, that's the point. I mean, I think the difference between someone who takes our courses and myself or Tom or other instructors is we only have a level of confidence higher than you. That's all it is. You can have the exact same knowledge in a short period of time that Tom and I have. The only difference is I put on trades all the time. I have no problem picking up the phone, putting on a trade, doing this, and I've done it so many times. It's actually fun. It's like second nature, and it's actually fun. And weekends are tough, because you can't figure out there's no playing. You can't play on a weekend, so So the bottom line is, I want you guys to get to that point where you love this. So, it's incredible. You love waking up. You know there's going to be some great opportunity. You love sitting there looking at the markets. You know that tomorrow's going to be a great day. And not that we win every single time, but let me tell you, you don't have to win every single time. Basically, the way to look at it is like a baseball player. We're going to strike out every once in a while. We're going to hit singles, doubles, triples, a couple grand slams a year, and you're going to have a good year. You're going to certainly beat a mutual fund's performance, which is, unbelievable. So, all right. Let's talk about why people usually do fail. One is lack of knowledge, which you're going to take care of that in the next couple days. You're going to go up a learning curve incredibly fast. You're going to learn exactly what a floor trader learns in a short period of time, okay? And you're going to learn, basically, like I said, 7 years of my life. In a short period of time, in 2 days. So you're going to have the knowledge. You're just going to have to go out there and start using it and playing with it and getting the confidence. So we're going to take you through the knowledge as quickly as possible. The wrong types of trades for your personal account, what we mean by that is that maybe you're just, you got too much money in stocks. You got too much money in whatever, cash or bonds. Or you're taking too much risk with one trade. And what we need to do is try to fit whatever account size you have into whatever type of trading style you're going to have. We did, I don't know if some of you, we were at a seminar not too long ago. We did a stock called Elaine Corp. Was anybody there where we found an option? It was a 5-minute, we used something called the 5-minute success formula. I told everybody, buy this option at $50. Well, I said, I suggest this is a good buy. I can't tell you. Run out and do something. Usually what you're going to hear is a hint. Oh, that looks pretty good. Okay, that's like a hint, guys. I'm not going to tell you, run out and do something. It's like, oh, I'd do that, something like that. And, the option was $50 a piece, $50. And by the end of the day, in 4 hours later, it was around $90. So we're talking about, a nice return just in that class. Today, just a few months later, that option is trading for $900. So it's gone from $50 to $900. And you know what? You only had to follow a certain system that we had. And we're going to give you tons of examples like this. And it's just amazing how just following a certain system, your return on investments could be sickening sometimes. And I know it's not really a sick thing to make money, but but it's hopefully you'll be shocked every once in a while, because that's a grand slam. And when you hit enough of those, you hit a few of those in a year, you're going to do well. Okay, people who are stressed out. This is another reason people fail. People who get stressed out over what they're doing. If you are stressed over your stock position, you're doing something wrong. If you're waking up every morning saying, oh no, here it goes again, you've done something wrong. So if you put on an options position where you wake up and say, oh, or you can't sleep at night, not because you're excited, but because you're worried, you're in the wrong trade. You need to find something that makes you nice and calm. You don't care what's going on. You can be on a plane to Aruba, and you really don't care what the market does, and because nothing in the world can hurt you. When you put on trades or positions that cannot hurt you, cannot hurt your lifestyle, you're not going to be stressed, okay? And that's what we need to do. Listening to other people is a big mistake. Brokers, people on TV, everybody else, even listening to us. What we want you to do is to test us and say, hey, these guys, they sound like they know what they're doing. Go back and you test us. That's how you're going to build the confidence that we know what we're doing. And even though I know we know what we're doing. So it's, but I mean, the bottom line is, you got to build your own confidence level up. People scare themselves out of good trades, meaning, oh, I'm panicking, I'm losing money, I got to get out of this thing, I'm going to lose, whatever. Whatever. This month's rent, which obviously you shouldn't be trading with money that you're going to panic like that. So people scare themselves out of trades. They're in the wrong trades. People give up. I lost my trading account 3 times before I figured out what I was doing. I just kept saying, I don't care what happens. I was a CPA, and boy, I did not like my job. And I worked for a firm called Arthur Andersen. You ever heard of him? I was not an auditor, thank God. I was in the consulting department. But I mean, I used to go to work this is a true story. I'd go to work, I'd drive, I was in Miami, which is where I live most of the time. Driving through Miami, going through this beautiful area, seeing these beautiful yachts, saying, that's what I want to do one day. I don't want to be driving, to work today. So I said, I'll never give up, and I'm going to figure out this business, because I'd met so many people who got really good at this. And you realize that it's a great lifestyle once you figure it out. Last but not least, people just don't know the rules, and you're going to learn all the rules. When do you get in? When do you get out? What's a bad time to put on a trade? What's a good time to put on a trade? How do you find good stocks? How do you find stocks to short or to go, that are going south, which there's a lot of them these days. In fact, just watch TV. Accounting irregularities, short it. It's going down, and it's going to go down for a long time. I'm going to show you that tomorrow. I mean, it's amazing how just watching TV, I can find a good stock. I'm sitting there flipping accounting irregularities, down. We'll show you how to make money from those. Okay, let's talk about what a stock is. Most of you own stock, and really all it is just you're trying to buy a piece of a company that hopefully will have value someday. Greater value than what you bought. However, hopefully it doesn't become a WorldCom, right? Where the value goes to 0. Well, they haven't filed yet for bankruptcy, but they will. So that's my guess. But the bottom line is you're owning something, not because most people are not doing it because they want to own a piece of the company. They're just doing it because you want to make some money. You get margin allowed. Margin is the amount of money you have to put up. If those of you have never traded before, margin means you're going to put some money up. 50%. What it means is if you've got $10,000, they're going to allow you to play with $20,000 worth of stock, which is a very risky thing because margin can also, or leverage, which is what we're going to talk about 2 to 1 here, you basically can leverage yourself for every dollar, you can buy another dollar. That was allowed by the Securities Exchange Commission because they basically said that's safe. You think that's a little different now? I mean, they're thinking a little differently. You can buy or sell stock short. Anybody here short stock? Short stock? Short stock means, just so that if you don't know what the term is, it means you're borrowing it from somebody like the broker. You have to get approval. They have to have it there. You're actually going to borrow it from the broker so you can sell it. So you borrow stocks at 50. I'm going to call my broker up, say, hey, I want to short a stock. They look at their inventory. They have it available. They're going to say, okay, it's now yours. You have now borrowed it at 50. So now you're hoping it goes down so you can buy it back cheaper, is really what shorting a stock is. All right, which is what a lot of people, and I saw this recently on TV, a lot more individual investors are starting to get into, because they realize that, hey, this market doesn't look like it's going up. So they'd rather sell something high, buy it back cheaper. So that's really what shorting a stock is. It's one of those strategies. We're going to show you how to do it with options better than borrowing it from the broker, because if you sell a stock short, you basically have unlimited risk, okay? If, for example, you sell a stock short at 50, how high can it go? It can go forever. It can go to infinity, theoretically. However, if you buy a stock, it can only go to what number? 0. Okay? So buying a stock has limited risk to 0, as painful as that is, whereas selling a stock short can go to infinity, theoretically. Not that it's likely to happen, but it certainly could happen. Okay? Last but not least, and this is the most important thing, it's a dollar for dollar move. All right, which means that if the stock goes up $1, you make $1. Stock goes down $1, you lose $1. If you basically bought the stock. Let's take a look at the first thing, which is the picture of what buying a stock looks like. This, by the way, just so you know, is the ugliest picture there is. Now, every picture we have, just those of you who've never seen this is called a risk graph. And it's going to have two lines, the profit and loss line and the break-even line. The horizontal line there is a 0 line. Okay? So basically, if it's above the 0 line, you're in good shape. Below the 0 line, you're losing money, the horizontal line there. This is a picture of your stock. If you own one share of IBM, this is what IBM looks like. If you own 10 different stocks, you have created 10 of these pictures. There's no diversification. There's basically no hedge if it goes down. Meaning that if it goes down, 10 stocks go down, you've got 10 of the exact same pictures on top of each other. If you have 100 stocks, what's it going to look like? 100 of those pictures. Okay? So once again, let me just show you what each of these pictures are going to look like, because this is going to be an important part of what we do. Whenever you see these things, you're going to have the horizontal line, which will be your break-even line. And then you're going to have your profit and loss line. So when we create our pictures, we're going to want to everything's going to have this view. Okay? So if I put on 3 stocks, they're all going to look the same. You're going to have 3 stocks that look like this. That's the picture. And once again, what do I say about that picture? It's ugly. That's one ugly picture. I know a lot of you are saying, well, why is it so ugly? Because of this. There is a lot below the 0 line. And there's nothing other than hedging it, which we'll show you tomorrow. You know, we're going to show you how to limit risk on stocks you own. But if you have 10 stocks, this is what the 10 stocks will look like. If you short the stock, if you do the opposite, you sell the stock short, what do you think the picture is going to look like? Anybody guess? It's going to look the opposite. It's basically your mirror image. Okay, so you sell a stock short. Okay, what happens is if the stock goes down $10, you make $10. The stock goes down $10, you make $10. Okay, so if your stock goes up $10, what happens when you sold the stock short? You lose how much? $10. Very good. So it's basically a dollar for dollar move. So if you have 10 stocks you sold short, is that a good picture or a bad picture? It'll be a bad picture. Okay? And once again, if you've got in your portfolio right now, one thing I want you guys to do is you walked in here, evaluate your portfolio. Say, man, I can't believe I'm doing that wrong, I'm doing that wrong, I'm doing that wrong. And what I want you to do is recreate your portfolio into a better portfolio. I'll show you tomorrow how to do that with a lot of stocks. For example, I have someone in my family owns a ton of Procter & Gamble stock. He worked for Procter & Gamble for many years. It was like an Enron situation. Basically, Enron, he was in his 70s, and every time the stock went up, he'd be excited. Every time the stock went down, he'd have to go to the doctor and check his heart, which I thought was not a good situation. So what I did is I transformed this portfolio into a lower risk, much lower risk portfolio. I'm going to show you how to do that tomorrow. In essence, I gave him the exact same upside with only about 10% of the downside. So the other day, Procter & Gamble was down $5 on Friday. I called him up and I said, how do you feel? He's like, I am so happy I listened to you. And I said, well, that's good. At least someone listens to me once in a while, you know. But, he says, I can't believe I took all this money out of the market. I got it out of money market funds. I had the exact same upside that I had before. But you know what? The stock's down $5 and I could care less. You know, I just feel really good today. And I'm going to show you how to do that tomorrow, because for a lot of you, you're going to want to do that exact same strategy. Because in a market like this especially, okay? So we're going to transform your portfolios. You should come in with the assumption right now, unless you're one of our advanced students and you're doing doing real well, you should come in with the assumption that no matter what you'd have, it could be better. I'd come in with that assumption every single day. And no matter how smart I am, is there another thing I can do to make it even better? And I want you to think that there's always going to be another solution. All right, let's get into the crux of what an option is. This is the most important part of what we're going to do. An option is a contract between two parties, okay? You're going to control, when you buy an option, it's control of an asset. All you're going to do, like buying a stock, when you buy a stock, you're controlling a stock. When you buy a car, you're controlling a car. When you buy a house, you're controlling a house. When you're buying anything, you've got an asset. Now what we're going to do is we're going to control that asset for less money. Okay? How many of you have seen the no money down real estate deals on TV? Good, no money down real estate is the same concept. Control an asset for as little cash as possible so you can then sell it to somebody else at a higher price and get a good return on your money. So what we're going to do, instead of having a house, instead of having a car, instead of having anything, what we're going to, a business, whatever it might be, is we're going to control 100 shares of stock for every single option. So one option controls how many shares of stock? 100. If I buy 10 options, how many shares am I now controlling? 1,000. Very good. Okay. Buyers have rights, sellers have obligations. Very important. Buyers have rights, sellers have obligations in an option. There'll be two parties to an option, a buyer and a seller. Just like when you have a house, isn't there a buyer and there's a seller? When you buy a car, isn't there a buyer and a seller? You have the car dealer as a seller, you're the buyer. Okay, so in business, there's always going to be a buyer and a seller. That's what makes a transaction. So when you buy an option, there'll be a buyer and there'll be a seller. You're the buyer, I'll be the seller. Okay, in some of these examples. When you buy an option, you have limited risk. Okay, so the option buyer can only lose what they put into the option. Very, very important. If I buy an option for $500, how much can I lose? $500. If I buy an option for $50, how much can I lose? $50. Okay? All right, so you need to understand, sellers of the options have obligations and they take more risk. Remember that. If you're going to sell an option, you're going to take more risk unless it's covered by something else. And we're going to explain that as we go. Uncovered options means you've sold something. So if you sell something, you've taken on what? An obligation. Isn't that right? You sold something, you have an obligation to do something. If you have nothing else, if you have no rights anywhere else, you have taken too much risk, basically is the way to do it. So if I sell you, if I go ahead and sell you a house and I don't own that house, is that a risky thing? Yeah. All right, that's exactly it. I mean, that's exactly what you're doing. You're selling an obligation. You don't have the asset right now. That's the way to look at it. If you sell an obligation to do anything and you don't have that asset, you've taken a lot of risk. Let's say I sold an option. There's an options on houses. I sold I sold someone else's house to somebody for $100,000. Okay? And then the house was transported to this market here. Okay? And the house is now worth $7 million. Right? In a normal market, the house is probably $100,000. Here it's $7 million, from what I've seen. I don't know if your market's changed, but I did once drive around and I was looking at houses because one of our partners was buying one, and I was appalled, by the way, guys. Houses that I would buy in Miami for $70,000 were going for $1 million. All right? And I couldn't understand it. I couldn't understand it. I was like, you have got to be kidding, But anyways, let's not go down that road. But so if I sold somebody else's house and I don't own it, and that house for 100 grand, and the house value went to 7 million, how much am I now going to have to pay for that house? 7 million bucks, just to exaggerate the point. But once again, that means you have sold an option uncovered. An option is just a right or an obligation. Just got to remember, there's going to be two parties, and there's two types of options, calls and puts. So basically, what you've got is you're going to have an option, you're going to have a buyer, you're going to have a seller. A buyer is going to have rights. The seller will have obligations. If you want to buy an option, who will sell that option? Anybody know? Tell me. Who sells the options? You want to buy an option. You've never done this before. You don't even know, you're just for the first time ever, I'm going to buy an option. I'm going to buy a right to control something. Who's going to sell it to you? It could be anybody. It could be another person. You're not going to know. You could call your broker up or put it online, and what's going to happen is it's going to go through a computer system. If it's a smaller number of options contracts, 20 or less, a computer will probably match it with somebody else. If it's larger than 20 options contracts, it's going to typically go to the floor traders. The floor traders are what's called market makers. Their job is to make a market, which means they're going to give you prices. So for example, if you want to buy a certain option, whether it be a call or a put, which we'll get into a while, and you basically, the prices you see on your computer screen or you get from your broker or whatever it might be is 2 to 2.25. That's going to be an options price. You're going to pay for this option $200 to $225. Why is it $200 versus $2? Because you're doing 100 shares of stock. So since you're controlling 100 shares of stock, it's 100 times whatever the number is you see. So if I buy an option, if I want to buy the option, the other person, I'm the market maker. I'm going to make you a market, okay? But basically says, I'm going to be willing to do two things. I'm willing to sell it to you at this price, and I'll buy it from you at this price. The market maker's job is to give you two-sided market. They're not going to just give you, well, I only want to buy them, I only want to sell them. They can do that in their own pit if they want to, but their job is really to create a market that whether you want to buy it or sell it, it's irrelevant. We're willing to do it at this price here, okay? Why is it that they want you to buy it at this? They're willing to buy it at this price and sell at this price because they are going to try to make this 25 cents in the middle, which is called the spread. This is how they make their living, by the way. The floor trader who pays a lot of money to stand there in the trading pit, yell and scream and this and that and take risk and whatever, and their job is to stand there every single day and try to make as much as they can from what's called this spread. Your job is to try to do what? Take as much out of their pocket as possible. So you're not going to do something called a market order. A market order means take whatever money you want. That's not a good thing. Okay, by the way. It's like going finding someone who wants to rob you, or actually it's finding someone on the street and saying, here, take as much as you really want out of my wallet. That's not a good thing. So what we're going to try to do is change it so it's to our benefit. Let me give you a little hint. The real value of this option, if you want to try to figure out the real value of the option without going through mathematical models and all that, where do you think it really is? Right in the middle, okay? If you really truly want to know what they call the, quote, real value of the option is, it's going to be right in the middle. That's what they call a theoretical price, but I can tell you, without running any computer models or whatever, that when they did their computer models, they said it's in the middle. We are going to take a little bit on this side, or we're going to take a little bit on that side. If you want to give them a little bit because you're going into a long-term trade, whatever, it's up to you, but I can tell you where the real value is. It's right in the middle. Okay, so that's a little trick that a lot of people don't understand, because their job, once again, is to stand there for hours and hours on end and take the risk of taking the other side of the trade. Okay, so if you buy an option, if you want to buy it and I'm going to sell it to you and I'm a floor trader, okay, what's going to happen is as soon as you buy it from me, I've sold it, I have now taken a directional trade. The floor trader's job now is to hedge his position, right? The floor trader does not bet that you're wrong. The floor trader's not sitting around as, that person's wrong, I'll sell it to them. Okay? They're sitting around saying, can I make this little bit of money as many times as I can? They then try their hedge their positions, and let me tell you what the time frame typically is for a trade. You want to be hedged within 10 seconds. So that's a long-term trade after that. Unbelievable, isn't it? Most people think that the floor trader, they just buy and sell because they think we're going to be wrong. They could care less who you are, whatever. They're going to sit around, they're going to say, hey, if I can make 25 cents or $25 and I can do this 100 times, I've just made $2,500. I've had a good day. And that's what they're going to try to do. And they don't want to sit around thinking you're wrong. They could care less. They're going to hedge their positions as fast as possible. Whereas Richard mentioned earlier, most people never hedge their portfolios. I mean, it's kind of a sad thing, and maybe it's going to come around, but you guys have to buy house insurance. You got to buy car insurance. The mortgage companies make you buy house insurance. The states and the governments make you buy car insurance. No one forces you to buy portfolio insurance, which is someday it might's going to come around. And I thought that's where the government was leading after the Enron situation. So the bottom line is, I want you to think more like a professional trader. The professional trader says, let me give you the clue of why over the years you should be successful. When you put on a trade, the first thing you should say is, I think the market's going to do this. I'm going to go ahead and I'm going to put on this trade. Well, you know what? You should also then ask yourself, what if I'm wrong? Because the what if I'm wrong is more important than what if I'm right. That's kind of my philosophy, is that you're going to be wrong sometimes, and when you're wrong, you don't want to get hurt. Basically, all the markets are doing is you're playing chess with the markets. That's the way I look at it. I'm going to make a move, it makes a move. I make a move, it makes a move. I make it a move, it makes a move. I want to checkmate the market at some point by all the moves that I have made. And what I want you guys to realize, that's exactly what's happening in the market, is the market's making moves, throwing out a lot of useless information that you have to decide what is useful, and then you've got to make a move. The market's going to make a move. If it hurts you, then you've had to have done something else, or you should have protected yourself somewhere else. That's why you're going to see all these different types of strategies we do. So once again, an option is just two players. The typical person who's going to take the other side of it is going to be a market maker or a computer. It's going to be a computer matching service. It's everything, all your orders come in, they get match, 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 match. They go to a certain period of time. When you want to sell a position, say you bought an option, will there always be someone you can sell it to? What do you think? Typically there will be, but it's going to be depending on what? The price. The bid-ask spread, right? There's going to be somebody. Tell you, you can buy anything at any price. For example, if you want to go buy a new, the new Mercedes SL 500, new car, beautiful car, whatever, there's a 3-year waiting list with Mercedes-Benz. So if you go to the open market today and want to buy one, are you going to pay a premium? Yes. Okay? There's going to be a bid, there's going to be an offer. And that bid and offer on something that there's not a lot of, it's going to be wider, isn't it? If there's a ton of stuff, let's say there's an esoteric stock, that trades 10 contracts a year, right? Versus IBM. Which one's going to be easier to get in and out of? IBM, obviously. Just because it's just a lot more people going to trade it, okay? So please, I just want you to understand that all an option is a way to control an asset for less money.
In this session, George Fontenelle's reviewed the basics of options trading. Let's take a few minutes to review the most important points. Options enable traders to increase their chances of making money by simultaneously lowering costs and lowering risk. Options also enable traders to be more creative in their ability to match market scenarios to specific option strategies. Why do people usually fail when they try to trade the markets? They place the wrong types of trades for their personal accounts. They become stressed over the trades they've placed, which leads to more mistakes. They listen to other people who often end up giving them poor advice. And last but not least, people just don't know the rules. To become a successful trader, you have to know how stocks work, how to leverage your capital, how margin works, how shorting a stock works, how to read a risk graph, and you must be fully versed in how options can be traded. This concludes CD number 1 of the Optionetics audio series. When you're ready, please insert CD number 2. CD number 2, Introduction to Stocks and Stock Options Trading, continued. Welcome to the second CD of the Optionetics course audio series. Now, let's return to George Fontenelle's and his introductory lecture about option basics.
The first type of option we're going to go into is called the call option. You have your two parties. All a call option means is that you want to control it to buy it. Okay? Calls mean that you want it to go up. You want to buy this asset if you're the buyer. Okay? You want it to go up. So the buyer wants it to go up, the seller wants it to go down or sideways. We'll get into that in a minute. So if you want to buy call options, it's because you think it's going which direction? Up. Did I repeat that enough? It's going which direction? Up. Okay. Calls means it's going up. It's kind of like an example we use. It's a rain check. You go into a store, you want to buy something, they don't have it available for you. They'll give you a rain check that says you can buy it at this price by this date as soon as we get it. You're going to control an asset by having this rain check. Okay? So let's take, if you want a stock like Intel. Pick a stock like Intel. Intel is now trading at roughly $19 or so. How many of you think Intel's a good deal at $19? Anybody raise your hand? Don't be shy. Okay. Anybody here work for Intel? Come on, you can admit it. Come on. I've had people say, I didn't want to say it during the class, but I work for that company. But okay. But anyways, Intel's a good company. There's no doubt about it. I mean, yes, there's a lot of competition, et cetera, et cetera. Are there some problems? Yes, the market's taking it down. But a lot of people think Intel's a great deal at $19 a share. Okay? It would be a better deal at $15 a share, right? So that's the issue. So if you think Intel's a good deal at $19 a share, what are the things you can do? What can I do? Buy the stock. And what do I say about that already? What do I say? Forget it. Forget it. No stock for me. So the next thing is I can buy what kind of option? A call option, which gives me the right to control Intel. Okay? All right? So basically what happens is if I want to buy any stock, whether it be Intel, Microsoft, or whatever, what I need to do is decide how to control it. Stock is not the right way to do it. Options are the way to do it. And if you're going to do it from the buyer's side, you want to control it from the buying side because you think it's going up, you're going to deal with call options. So once again, it's just a cheaper way to control something. We're going to decide which ones to control and how much you want to put up in a trade and all that stuff because it makes a difference. The one thing you're going to hopefully realize is even though our accounts may be larger, even though we may trade bigger numbers of contracts, we have the exact same objective as you. Now, let me tell you, my objective is exactly as you, and it's probably even more aggressive that I want to control the risk. I try to keep my costs low. I try to control the risk. And you know what? In the end, I don't want to be hurt. And that's the way I live my life as a trader too. I want to have the opportunity of making money, but I also want to put as little money as I can in a trade and not just going to do more of them. That's the way that I trade. So once again, a call option, you're going to have the buyer has a right to buy the stock. You're going to have an agreed to number of shares, an agreed to price. What is the price you're going to control this at? What is the time frame you want to control the stock in? Okay? And you can control it right now for the next 30 days, which is the next expiration period, or you can control Intel to the year 2005. There are options right now that go out to the year January 2005. So how many of you think that Intel will go up in the next 30 days? 30 days? Raise your hand, 30 days. Okay, how many of you think it'll probably go up between now and the year 2005? There's an easier bet to make. More hands obviously go up. So for longer term, being bullish, Intel is probably a good idea. Shorter term, who knows? Probably bearish, actually, just the way the stock is trading. And so once again, I can have whatever perspective I want to do. And then you're going to pay a fee to do this. This is called the premium. The premium is basically how much you're going to be willing to pay somebody to take the other side of the trade. So if I put on a trade, let's say you want to buy a call option on Intel that expires in 30 days, all right? And then this group wants to do it in 30 days. This side over here wants to do it for the year 2005. Who's going to pay more? The group for 2005, because there's a longer time frame at which they can be right and I can be wrong. and therefore I'm going to put that into the premium. Isn't that true? So if you think of it, if you're going to control an asset for a short period of time, it's not going to cost as much as going for a longer period of time. All right, but let me tell you, on a percent basis, shorter term options will cost more than longer term, not on a dollar basis. What I mean is, even though there's a longer time frame for these to expire, the shorter term options on a daily basis, day-to-day basis, is going to cost more, and we'll talk about that in just a little while. Options expire the third Friday of the date at which you decided to buy that option, or for that expiration period. So if you buy a January 2004 option, when is that going to expire? The third Friday of January 2004, whatever that date is. If I buy an August option, when's it going to expire? The third Friday of August. December, the third Friday of December. Most options that we buy are not because we want to take them to expiration and then exercise these. Exercising an option means you take your right, you turn it into the asset. Okay? We do not do that. I do not go into buying an asset or buying a right for an asset and exercising the asset, because what do I think about the asset? I don't like it. Because if you turn an option into a right to buy a stock, you know how I feel about stock. Why do I want to do that? Okay? So the bottom line is, we're not going to typically hold these to expiration, which means we're not going to convert them into the asset. We don't want the asset. I don't want the stock. Stock is too expensive and too risky, and I don't want to do that. Okay? So the third Friday, and we're going to show you about those. Okay? The seller, on the other hand, has taken the opposite of this position. You guys bought an option, the right to buy Intel at a certain price on a certain date, whatever it might be. I sold you that option. I'm the market maker. I sold you that option. I've now got an obligation to do what? Sell you Intel at that price by that certain date if the option has value. Okay? So basically, if you buy an option on Intel, in fact, let's go ahead and do a little example here. And we'll talk about this in a minute. Intel, INTC is the symbol, trading roughly $19. If I go ahead and I buy the August 20 call for Intel, say you went ahead and you bought 2 August 20 calls for Intel and you paid $2 for those. That's actually how you place an order. You're going to buy or sell something. How many of the options are you going to do, which controls how many shares of stock? How many shares of stock am I controlling? 2, and I'm controlling the asset through what period? The third Friday of August. Where do I want to buy the stock at? $20. Is it a call or a put? Okay, you'll see this will be the same for call or put. What is the asset? What is the premium you're willing to pay? Okay, let's start it again. Buy or sell, how many options, which controls 200 shares of stock, and what is the price that you want the stock at? Here it's $20. Okay, control price, which is called the exercise price. That, in essence, means that you've decided Intel's going to go up by August. You want it to be above what price? 20. And you're willing to pay a certain amount of money for that right. Let's say the stock closes at $21. The stock's at 21. Your right to buy Intel, you have a right to buy Intel because you had a right to buy it at what price? 20. It's trading at 21. It has real value in there, which we'll talk about in just a little bit. So the only issue is whether you'd even want the stock. So what do we say again about buying stock? Don't do it. And I know if I do anything good in over 2 days, is I'm going to make you think twice before you go buy stock again. Okay? If that's all I do, and then you can do whatever you want. You can buy as many shares of stock as you want, whatever. You're all adults. Do whatever you want, but don't say I didn't warn you. Okay? And so what we're trying to do here in this case is control an asset for a certain period of time. I don't want to exercise my rights, and I'm going to pay a certain amount of money to do this. The buyer and the seller have taken opposite positions, right? They've taken the opposite view. The seller of this option thinks the stock is going to go down or sideways, where the buyer thinks it's going where? The buyer thinks it's going up. The seller thinks it's going down or sideways. Why down? Because if the stock now goes down, that option will have no value. If the stock's at 19 and can't get to 20, then that option has absolutely no value, right? If someone has a right to buy stock at 20 and it's not at 20, there are no rights. So if it expires, if it never reaches 20, the seller is going to keep how much money? $2.
CD number 3, Beyond the Basics. Welcome to the third CD of the Optionetics audio series. In this CD, we are introduced to Tom Gentile, who will reveal how to enhance trading systems by using options. Tom Gentile is the co-instructor of the Optionetics seminar series and the chief option strategist for the Optionetics team of traders. From his humble childhood as the son of a steelworking family, Tom Gentile has not only become a very successful trader, but a renowned educator, author, and businessman as well. Tom began his career in retail and corporate management, but headed to New York in search of a career in the markets. In 1993, he made the jump to full-time trading by landing a job at the American Stock Exchange. As luck would have it, he ended up working alongside famed trader George Fontenelle's. Their powerful connection gave birth to Optionetics. Since then, Tom has cultivated a unique style of trading that could be described as fundamentally contrarian, yet 100% technical. Tom is also the author of numerous articles, publications, and manuals that promote the use of low-risk, high-profit trading strategies, including 2 best-selling books, The Stock Market Course and The Volatility Course, co-written with George Fontenelle's. In addition, Tom Gentile is a dynamic speaker in the United Kingdom, where he is building a well-deserved reputation as the options guru for UK option traders. As an up-and-coming market wizard, Gentile's passion for trading and down-to-earth style is both refreshing and sensible in these volatile times. And now, here's Tom Gentile.
For those of you that don't know me, shame on you. You didn't watch the videos. I'm Tom Gentile. I'm the Chief Option Strategist here at Optionetics. I've been around for about as long as any of the old furniture we've had in our offices. I was actually at George's third training seminar that he ever taught. And, I'm looking around the room and I see some people that I've seen for quite a while, and it's good to see you guys back again. Let me tell you a quick little story. I was on the airplane heading over here. Now, I had recently, I'm one of those guys where I probably buy stuff, for the house that's a little bit more out of my means. Like an example, just recently, I got a pretty decent-sized backyard, and we're always trying to find somebody to do the grass. And I got upset because I couldn't get anybody on the phone, so I went over to John Deere and I brought a tractor. It's a little bit bigger than what I need, but it's fun. It's fun sitting up and driving one of those things. Well, they gave me a John Deere hat, because when you buy something that's several thousands of dollars, they'll throw in a $12 hat for free. I got my John Deere hat on because it was, guys, if you think it's hot out here, you should mix that with a nice batch of humidity, and you get Georgia. So I'm driving to the airport. I got my hat on, and I'm getting on the airplane. I got my hat on. I land here. Now, this is interesting. This group of people came up to me and they said, "Hey, you work for John Deere?" And I kind of played along. "Yeah, wow, you're a great catch." I said, "How's that? You got a stable job." I thought it was cute. So anyway, a couple things I want to talk about. We've had some, obviously, the news in the news out there has been partly, if not mostly, cloudy. In terms of everything from Martha Stewart to the markets to Enron to WorldCom. Martha's, this was a couple of things I grabbed off the news. Martha's got a new Insiders Book Club going. Well, wait a second. I'm reading that wrong. She's actually being booked for being in an Insiders Club. And now you guys know about America West. We don't have America West out out in Georgia. But they released the two names of those guys that were flying under the influence. I believe their names were Jack Daniels and Jim Beam. Isn't that right? Isn't that right? In fact, this is hilarious. I was watching. How many of you guys get your news from CNN in here? Who gets their news from CNBC? Now, how many of you get your news from Jay Leno, The Tonight Show? Okay? That's the place that, if you really want to find some good trading tips, I'll tell you what. People are getting more of their news from The Tonight Show and these entertainment shows than they are from anything else. And once these guys say something out, once they make something public on the news, everybody knows about it, and that's really the time to be looking at a trading opportunity. America West have been plummeted so bad. It's funny, they had a guy come on posing as an America West pilot on The Tonight Show just a couple nights ago, and he says, Jay, we're not, about the drunken pilots, we do not tolerate this in our organization. If we find it out, we're immediately sending them to AA. Jay says, AA, you mean Alcoholics Anonymous? No, American Airlines. He says, we don't want any wimpy pilots in our organization. Crazy. Well, our diet over in Georgia is, we've had the type of companies that are out there that the Southerner invests in is Krispy Kreme donuts, tobacco products like Philip Morris, Budweiser beer. These are like 3 of the 4 basic food groups over there. So this is the kind of investing that goes on over there. What do we want to talk about over the next 2 days? George started with the basics, and what I want to do is, because I see more new people in the room than repeats, and I know I saw a lot of hands go up for people that had never traded options before. What we want to do that's a little bit different is I want to take some of my personal systems. And I haven't been here in I want to say, probably a year in San Francisco. Is that right, Kathy? About a year? Nader? And I haven't seen you guys in a while. And so I want to show you what I've been doing over the past year. I want to show you some systems that I've been teaching at the last few seminars I want to show you here. And these are systems that anybody in this room can do. I'm going to give you 2 of them this morning before lunch that doesn't require anything except maybe the ability to look at a couple of charts. That's it. All right? One of them is a long-term system, meaning you're only going to do it about once a year, which would qualify everybody in the room. And one of them is a shorter-term system where you're going to see trades a couple of times a year, but it's going to be in a 30 to 60-day window from the time you get in to the time you get out. So I think I'm going to pretty much span the whole gamut here before lunch with one of these 2 trading systems. Some of you will like one, some of you will like the other, some of you will like both. So, before I do, I wanted to just mention a couple other things. Got Dow below 8,000, and this was the headline in Atlanta Journal, and it was the headline about everything. Dow at 4-year low as stocks tumble. When you start seeing more and more of this becoming front page news, then it's more likely that what's going to happen. We're going to get, first of all, the public, which gets, I think the media is a very big contributor to where markets and things actually go. Because, look at them. I'm not trying to do this from a political or conspiracy point of theory. I want to do this from more of an advertising point of theory, because that's what the media is. They're advertising the stocks going down just like Kmart might advertise a pair of shoes. If Kmart puts it on the blue light special, more people that walk into a Kmart will see it. And if someone puts a news story on the front page, then more people are likely to see it, and they're going to act from it. So are we going to have a big day down tomorrow? I think we might open down, because people are going to be looking at this over the weekend. They're thinking, oh boy, I got to get out of everything I own. And so they'll probably sell where? At the worst possible price, and then we'll probably start to have that little choppiness that may signal a shorter-term bottom. I'll tell you exactly where I think the markets are going to go. And by the way, 8,000. How many of you, say 6 months ago, had a clue at all that the market could have been at 8,000? Raise your hand. And some of you guys are raising your hands, I know, because we talked about this, didn't we? We talked about this. 6 months ago we talked about this. He knows, and Nader knows too, and a lot of you other people are in here know we talked about this. And so I want to go over how we're coming up with these directions, and simply what we're doing is we're taking a system and we're applying strategies to it. And we want to talk about the system again today. We want to talk about the strategies today. My idea is that the market's going to be really rough here in the next couple of weeks. What do we got going on by August 14th? What's got to happen? What's going on? What's the big news story right now that has August 14th tied to it? CEOs have to certify their books, which means that if they have skeletons in the closet, they got to bring them out now. Okay? That's right. The bones are rolling. So here's the thing, guys. If that's the case, I mean, look what's been happening. One company after another after another. Do you think this is going to continue, at least for the next 2 weeks? Could this cause the market to continue to be volatile? Yes. So, you need to think about that, but also think about this. Sometime between now and the next 2 weeks, could we have a shorter-term market bottom? Yeah, because eventually, if all the bad news is out, then we would have flushed all the sellers out of the marketplace by then, and we might get a little bounce up. Now, I'll give you a little bit more of my broader market perspective and where I think we're going to go in the next 3 months and where I think we're going to go in the next year. And I'll tell you exactly how I plan on trading around that, as well as George. Is there anything going up right now? Yes. What's going up right now? Oh, UPS. Okay, yeah. It's funny you say that because that's what I have right here. I pulled this up this morning, and this is the largest gainers for Friday. And I wanted to show this to you guys. The one at the top of the list is United Parcel Service, was up almost $5 on Friday. Surprise, surprise. You know what else is going up that really isn't on this list, but has been going up for several days, several weeks now, actually several months, is gold stocks, silver stocks. And how about those old Y2K stocks that we all forgot about 2 years ago? Go back and look at some of this stuff that we thought was crap a couple of years ago on January 2nd, 2000. Some of this stuff is actually starting to move back up again, too. And I think it's, more of a safety play than anything else. So what we're going to do is we're going to talk about, a couple of the stocks that are going up and some strategies we can play there as well. What I want to get into with you this morning is enhancing systems trading with options. All right? I started out as a trader almost 15 years ago. I was a terrible trader my first year. Absolutely the worst. Everything I could have done wrong, I did, and did it on the wrong day, too. Okay? And I started out with a $5,000 account, and what I did over the next 6 months is I actually ran it up. And then came October 19th. And you mix in a little October 19th with a little greed and a little, my first system called my TV trader system, which was I sat down and watched TV, and whoever had the biggest mouth that day, I was going to go with whatever he said. And I did that. And next thing you know, my account, which had grown quite a bit, went below zero. How many of you guys in here have had a margin call before? Okay? Yeah, it's not fun. I mean, and I remember today, like, we all remember, it's hard to remember what it took to get your account, as for some of us that are in this room, from a point here to a new high, but it doesn't take long at all to remember how it went from here down to the basement. And so, and in a way that's good because you need to have that fresh in your memory for those of you that have come here today and thinking that you're going to try to find a better way, because that'll keep you from doing it again, if you can keep that fresh. It's funny, we talked about what's going up, what's going down, everything, and this is the progression that's happened. You've started off with internet stocks, okay? Then we moved into technology, and that started dropping. And you know what's been dropping lately? Safety stocks. Stocks that the market has been saying are not a problem. Let me give you an example. I was on CNBC Europe. Okay, I do London every once in a while, and I'm going to show you something in here sometime today on some stuff I did over in London. And while I was on CNBC London, I was in the green room. Okay, that's the little waiting room that you go into before you actually go out on camera. Now, I'm in there by myself, and all of a sudden a whole bunch of suits come walking in. Okay? And I put a suit on today, so I should be talking. A whole bunch of suits from Microsoft come walking in, and they got the Xbox with them. All right? They're debuting the Xbox in Europe that day. So, they're in there smiling, they're hooking it up. Then the programmers come in and some of the custom people to hook it up so they could see it on CNBC. Well, they were supposed to go on first, and then it was going to be me. Then the program director rushed in and he goes, "Hey, Tom, any chance we can get you to switch with the Xbox guys?" I said, "Why?" "Well, we can't seem to get their product working." I said, okay, so I went out there, and you know what? I had this whole thing set up where I was going to talk about safety stocks to sell, and I had Microsoft on there. And so I wound up being a good guy and actually crossing it off. But, come to think about it, that was one, Microsoft, we talked about IBM. This was back in March and April when all this was happening. And these guys said, well, where do you think the markets are likely to go? And I said, well, I'm looking for a 20% pullback. And we were looking at this around the 10,000, 10,500 area. And the next question was, well, what can we as investors do about it? Now, interestingly enough, in Europe, they seem to want to know a little bit more about options or about different vehicles of investing than more of the buy and hold and sell that you hear on the TV here. So I talked a little bit about it, but it was interesting the reactions I got, because I had one guy from that you see on TV, but I can't see him anywhere near me because he's buried back in a corner somewhere, comes on, and he says, hey, isn't this stuff expensive? Isn't these options expensive? And I said, well, of course, if you're going to buy an outright put or an outright call, they may be, depending on what you're buying it on. But there's ways you can actually lower that down and actually drop it down to zero. We're going to show you how we drop it down to zero tomorrow. And so, the thing about it is that anybody in here that knew something, had a little bit of education on options, could have saved themselves a lot of headaches with the markets moving down the way they are just by doing a couple of simple hedge strategies. And we're going to talk about those a little bit later today. Give you an idea. Last week I was in Dallas, and what kind of a year have we been having? We've been having a great year, because we've been primarily bearish to non-directional. There hasn't been a whole lot of bulls we've been doing. I did some bullish plays in Coca-Cola. I did some bullish plays. I did a couple of things on EMC and some longer term, some very, very long-term stuff. But primarily, I've been bearish as a directional trader. And, an example, last week, one of the things that came up last week on a system I'm going to show you later today was, guess what? Baxter International. Baxter happened to be one of those companies where we got into it on Tuesday, and then guess what happened on Thursday? They came out and had to restate a few things. Stock dropped like a hammer. We were in on Tuesday and out on Thursday, and had a better than 300% profit. And, I think when I looked at it, I went and looked at the open interest, and I looked at, because we talked about this in the Dallas seminar last week, and I saw how many contracts were placed on Tuesday, and there was $500,000 that was taken out of Baxter, out of people that, people we talked about this trade to. So there were a lot of people taking it, and they were very happy about it. And so I'm hoping that we can do the same thing again here today, going into tomorrow and this week as well. So moving forward, how to enhance systems with options. What I'm really talking about here is becoming a systems trader. All right? Now, to become a systems trader, you got to do things that are out of the ordinary than the rest of the herd that's out there. Okay? In fact, I looked at, I was watching CNN this morning when I woke up, and there was a big debate on who was to blame for the market going down. And, this is exactly what happens. When the market goes down, everybody wants to point fingers. Guess who's being pointed at right now the most? Bush. You know why? Because he's an easy target. He's the head honcho of the USA. Let's point at him. You know who else is being blamed? CEOs. And even the media has a portion. And it's amazing how no matter who we seem to blame for the markets being down, you know what you got to do? You got to take a look at your own portfolio, and the person you need to blame the most is the person in the mirror. Okay, that's really it. So what we want to teach you guys how to do in the next 2 days is get away from that mentality, because the average trader, I think, is very similar to a puppet. Okay, what I mean by that is that there's a guy up here pulling strings, and that guy might be the CEO in case we've seen, and they're pulling strings on who? The media. And in turn, the media is pulling strings by doing what? Advertising about Qualcomm going to 1,000. Or, like they did the last couple of years. WorldCom being a great buy, And you just, as you see this that drops down, who's the ones actually making decisions on all this? You and I, the investor. All right? As we get garbage in, the more garbage that goes in, a lot of times the average investor will act on that garbage and, usually make a trade or do something that's required with a lot of emotion. And I found that the more emotion you put into a trade, the worse it's going to wind up being. Anybody in this room agree with me? Okay. So we're going to talk about systems trading. The average trader basically does this. Average trader is going to, I think that was going to start working sometime here. Average trader is going to use these 4 methods for their trading. Number 1, a discretionary method. What a discretionary method is basically what the average trader will do is they will find what I call discretionary is like lazy. They find the most laziest form of way of taking a trade and doing it. And the laziest form I know is by watching a buy, sell, or hold program on TV or getting a tip from your buddy. Every time I got a tip from my buddy, it wound up costing me money. I don't think I've ever made money on a tip, ever. Even in the position I'm in now, because I get more tips now than I ever did. I just don't take them anymore. Okay? Number 2, greed and fear. Greed, you could separate these two. Greed was post or pre-2000, and fear has been post-2000. And you've seen how both of those have reacted to people. Next is buy low, sell high, which most traders, that's the only method of investing they know, is let me buy a stock here and let me hope it goes up higher so I can sell it and make some money in the process. You know what? A lot of people did well in the year 2000. You know, it's easy to do well when 95% of the stocks that are out there are going in one direction, and it happens to be the direction that you're using the buy low, sell high method. Right now, it's the exact opposite. And fourth is the religious approach. And after you mix 1, 2, or 3 together, you will get the 4 at some time in your life, and you'll say, God, please get me out of this. I swear I'll never do it again. Right? And I didn't want to get into religion this morning, but I guess we could call this the church of the painful truth, huh? Because that's what it is when it comes to trading, and trading in a discretionary method. Now, that's the average trader. What we want to do, and like I said before, I also wanted to say is, how did money managers do? Well, obviously they haven't been doing that well this year because 401ks are now 201ks, right? I mean, that's what we got now for the most part. You look at this thing that George was talking about, this mutual fund, and that's about the right way of explaining it. Okay? So what is important as a trader? What is important to you? Now, I want you to take a look at these 3 things here. Number 1 is news. Number 2 is charts and indicators. And number 3 is systems trading. And put yourself in one of those 3 categories as of today, looking backwards. And I'm not going to ask for hands, but how many of you traded? Think about it. Did you trade off of news the last couple of years? Those of you that have traded before. Were you how many of you were chart traders? You trade off of charts and indicators, okay? How many of you feel like you're a true systems trader? That means you have a couple of systems back in your pocket, and you're just going to do them, and if the thing says, and if the setup says buy, you buy, and if the setup says sell, you sell, and you do nothing else. And you don't contradict the system. Because that's what I do, so I want to explain which each of these are, and how I got, and by the way, I progressed from 1 to 2 to 3. I didn't just jump to 3. I use a lot of car analogies, as does George. And one of the car analogies that I use, I'm a big muscle car freak, okay? I'm not a 2002 or 2003. I like the cars that were made back in the 60s, the ones you can't find anymore. And most of them, and you know what? Most of them you can find right here in the state of California, because anytime I'm looking for one, they're always here. California cars. Norwood plant put some of the best stuff out that you'll ever see. So, with that era, I talk about the 4-speed. Most people don't drive 4-speeds anymore. They drive automatics. But in a 4-speed, you can't just get into 4th gear and then push on the gas, right? Engine's going to die. You got to start out in 1st and work your way forward. And that's the same way I progressed as a trader, as I started out in 1st and worked my way forward. And I am going to talk about a lot of steps over the next 2 days. But you know what? Here's an area where I can tell you, you can eliminate 1st and 2nd gear and get into 3rd, and you're going to be in a lot better shape. All right? And I'll tell you what, 1st and 2nd, knowing a little bit about news is not a problem, and knowing a little bit about charts and indicators is not a problem either. But what you do is you take the 2 of them, you mix them together, and you create some hard, fast rules. So I'm going to show you a couple of these before lunch here. So let's start with news first. News trader. Now, this was me as a news trader. Most news traders are what I call short-term traders. They trade on media reports. Okay, if somebody comes out with an upgrade, boom, we're in buying. If somebody comes out with a downgrade, boom, we're in selling. Here's the problem with that. Usually by the time the news comes out, the move's already been made, right? Okay, how in the world can you and I possibly get in on that? Unless, of course, we had lightning-fast hands and we could immediately place that order before anybody else. And how's that going to be possible when the people who are trading short-term are usually right there at the exchange? They could be floor traders or they could be off-floor traders right there without having to go through an internet connection or go through a phone line. They have no lag. They have no lag time at all, and you and I have lag. And a lot of people say, well, I have real-time quotes. You know what? I was down at the pit, and George has been too, at several of these pits. The one that was most interesting enough was the New York Mercantile Exchange. Because the New York Mercantile Exchange is interesting. It's where they trade the natural gas and crude oil. And this pit, what happens is you've got everybody surrounded in the pit, and down at the bottom you've got a couple of machines and you've got some reporters. And the reporters are people who report fills. Now, here's their 2002 technologically advanced order system. They place an order on a ticket. They look at the badge number of the person they placed the order with, and you know what they do with the order once they've got it done? They throw it down into the pit. And these poor guys down there have to pick them up and punch them in, and they're keying in the fill. Now, imagine on a fast day when you got snow coming at you in the form of these tickets, and they're hitting you in the head, and I mean, you're picking them up so fast, and guess what? You're putting them in, hopefully at the order they flew down in, but guess what? When you see all this paper on the floor, you're going to pick up whatever you can first. So have you ever seen stock prices or prices that wildly fluctuate from one to another? Now you know why. Guy isn't picking them up at the order rate that the sell's happening. He might be picking up the low of the day that he should have put in after all the ones as it dropped down. Instead of it going tick, 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 it goes tick, 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 back up. And then, you know, that would immediately make you believe something that was not orderly when it was. So how good is real-time data? I think it's as good as you are being on the floor. Real-time data has its purpose, but I think its purpose is not to try to day trade. I got one day trader that I know that makes money consistently. Actually, he doesn't day trade anymore, and I'll tell you that story a little bit later. But he was the only guy I knew that consistently made 6 figures a year day trading. The people that I know that consistently make money trading are the position traders, meaning you're taking a position that's going to say 30 days or maybe 30 days or more on average. That's where the money is made in trading. It's not in day trading. Next, listens to everyone else, analysts, brokers, tips. I talked a little bit about that. Trading on noise, number 3. This is the impulses of the market, obviously, often reacting instead of pre-acting. And I used to be a reactive trader. And that meant that when I saw something move, I made a decision. And I learned that being able to pre-act before the markets moved was where the money was made. You know, as an example, I didn't know Baxter Communications was going to report. All I know is my system said sell. And said this thing's going to be going. This thing has a very high probability of going down. And so what did we do? We immediately looked at our strategies and looked at put strategies as one of the ones to take on Baxter. And so I'm going to teach you that system as well as we move along. Okay, so we've talked about news. Let's look at technical trading for a moment. Technical trading uses charts and indicators. You know there's over 1,000 indicators out there now? I mean, you look at the trade stations and the live trades and, you know, all the different amount of software that's out there, and there's tons of it. And I've got most of it, okay? I can tell you that right now. George is a big Viper collector. Somehow I seem to be a software collector, okay? And most of the stuff I got isn't even opened. You know, I got stuff I've bought, and I've got stuff people just keep sending me. Hey, can you evaluate this? You know, and you know what the thing is with software is that, and I'm going to show you the things that work. When you find something that works, don't try to fix it. Okay, that's the point I'm going to talk to you about, and I'm going to show you what works for me, what works for George, what works for all of the Optionetics traders, and some of you in here already know what I'm talking about, and I'm going to reiterate that to those of you that know what I'm talking about. Next. You know, as an indicator junkie, that's what I was when I first started looking at indicators. I'll tell you, I looked at stochastics. How many of you know what stochastics is? Okay, I'm going to talk about some of these indicators that make sense. Stochastics is basically an overbought, oversold indicator that's supposed to tell you when the market's due for a turn. Okay? That's the way most people trade it. Interestingly enough, stochastics, moving averages, MACD, and about 990 of those 1,000 indicators that are out there are all based on price. That means it's taking a different equation of price to create the indicator. So if all this stuff's based on price, then, you know, what I'm saying is that of the 1,000 indicators that are out there, half of them are telling you to buy and the other half of them are telling you to sell. So what do you do? And, you know, how many of you that are using indicators sometimes you put so many indicators on your screen that you immediately are like a deer in front of headlights afterwards? Exactly. Exactly. Okay, so I want to show you the 2 or 3 indicators that I think are worth looking at, and then I'm leaving the other 997 for everybody else outside of the room to look at. Which brings me to number 3, system trading. A system trader is one that may take news and or technical analysis and put that together to create a system, an objective trading system. What I mean by objective is something like this. If A plus B equals C, then you do D. That's it. You know, we all know in the room that 1 plus 1 equals 2. There's no argument about that. It's math. And so if you can create systems that are similar to that, where it's either yes or it's no, you know, it's either, and when the system says 1 plus 1 is 2, then buy, then we all say, okay, we got to buy. We got to buy signal. I'm going to show you a couple of those that are objective systems this morning. And what we do is, you know, what I do is I like to create a sound system. That means, and a lot of the systems I create aren't even mine. In fact, I'm going to show you 2 systems this morning that I didn't create. All I did was make them better. Okay, how did I make them better? Did I tinker with the system and make it better? Not necessarily. What I did was I tinkered with the strategy. Instead of buying stock, I looked at buying calls. Instead of selling stock, I looked at buying puts, and then even detailed it in from there. And I'm going to show you a strategy that's up about 6% this year. Okay, not huge by any standards. But then when you add options to it, and then we even go in and do some creative financing, all of a sudden now we're up in the high double digits for the year. And so that's how taking a sound system and making it better is what I mean. Number 3, refine any flaws and tests again, and then trade the system after you see profits. So that's what we're going to get into. When I create a system, George, myself, anybody, when we create systems, we always use this particular series of steps. Number 1, are we going to trade a stock for this system, or are we going to trade it on the index options, or are we going to trade a group of stocks? Now, guys, I've got to tell you something. When you see a guy like Nader over here, you know, Nader's been in this seminar too many times to even remember. And he's been around the block, and he's a very good trader. But when you see him writing this stuff down, then you know, or you see some of the guys that are with us in the back writing this stuff down, all of a sudden, is this something you hadn't seen before, Nader? Yeah, because you know why? Because I want to talk a little bit more about system trading and adding some stuff in that you're not going to see in the videotapes. Okay? And I'll tell you where I think you really need to write stuff down. And this is something you want to write down, because it is not there. I'm getting personal with you. I'm showing you some of the stuff that I'm doing that works. Number 2, and if you like this, wait till you see what I got coming after this. Determine the direction. Now, is your system going to be, as a system trader, are you going to be a directional system trader, or are you going to be non-directional? Are you going to be, is your system just going to take buy signals only, or is it going to also take sell signals too? You know, some systems I have will do both. The one I'm going to show you, the first one I'm going to show you this morning, only takes buys. Okay, which you might think, in this market, you're not going to get too many buys, but you will, and I'll show you why when we talk about it. Number 3, determine your time frame. Is your system going to be a day trading system? Is your system going to be a longer term trading system? How many of you in here have tried day trading at least once? Sue Can, you tried day trading? Twice, huh? You got both hands up. Okay. Here's the thing. I was a day trader for one day. All right, I'll tell you my one day. It wasn't even one day. It was a half a day. I had a system which I used, and I had this particular type of chart pattern that I liked, and I applied an indicator to it, a couple of indicators, and the system was 80%, back tested it up, 80% of the time I had winners. So I thought, hey, 8 out of 10? Not bad. And the winners were actually were on average better than the losers, so I really liked the system. So I back tested it, tinkered around with it, then I was ready to go. And this was back in 1997, before the internet, before online trading was really a big thing, so I had to call the orders in. So I had a direct line to the floor. So I'd call my order in and I'd say buy. And the system was working great. Here's my problem. It took a trade every 5 minutes. I mean, every 5 minutes it was going from buy to sell. It was a stop and reverse system, which means you were either long or short. You were never out of the market. So, I mean, literally, I had to stay there and just buy, sell, buy, sell. And, I mean, I really did feel like a day trader. And so, you know, in fact, at one time, I remember being on the phone with the floor, and they had a little trouble trying to, you know, get my fill. And they came back, okay, Tom, you were filled at such and such. I go, whoa, sell it now, you know, because the signal had already turned by the time they came back with the fill. I was like, no, sell it. You know, I felt like the guys on Trading Places. Get back in there and sell. If you've seen the movie, you know what I'm talking about. The thing is that, you know, and after that, what had happened was at the end of lunch, I was doing one lots, okay, because that's what you do. When you start out small, and then you move up bigger. And I was doing one lots, and I was up $3,000 by lunch. So I was like, hey, I got a heck of a headache, but this is a pretty good system. But I was beat, and I went to lunch, And I missed a few trades during lunch that were winners, but I had to rest, and I came back. The very first trade I took after lunch took away 90% of what I made in the entire 36 trades it took me to get to $3,000. One trade it took me to get down to 300. And I turned the machine off. I'm done. I'm not doing this. You know why? Because I couldn't handle. I didn't realize how, what the drawdowns on the system were going to be. And I couldn't handle taking 36 trades and really beat myself to death trying to get that money and then have it lost in one trade. So I moved on. Which brings me to number 4. Determine your strategy. After you do 1, 2, and 3, then we as options traders, now we don't just have buy the stock or sell the stock. We have buy calls, buy puts, and several other different strategies we can do too. So it's just a matter of being able to fit the right strategy with the right system. Now, I'm going to talk about the dogs of the Dow. How many of you in here have heard of the dogs of the Dow? All right? So those of you who have never heard of the dogs of the Dow, how many of you are just absolute terrible stock pickers? If you are, this is the system for you, okay? Because this involves some terrible stock picking, but it works. All right? What you're doing is we're going to use the dogs of the Dow. I'm going to apply all 4 of what I talked about with you earlier. We're using, what stock are we using? Well, we're actually using 30 stocks. We're looking at the 30 Dow Jones Industrial Average stocks. They're found anywhere on the internet. You can find all 30 of them grouped together. You can find them on our website. You can find them on any financial website. So we're going to use the Dow 30 stocks. We're going to scan them, and you can scan them with your 2 eyes, because it's only 30 stocks. And what we're going to do is we're going to do certain buys. We're going to buy certain stocks only. Now realize I'm taking you through a progression here. We're going to talk about the actual system itself, and then we're going to talk about the new and improved Optionetics way of trading this. This is a 1-year trading system, which means every year you're redoing the scan, you're looking for something, and that's going to tell you what stocks to be long on. Okay? And then the other thing is there is no risk management on this system. Now, that's because I'm showing you the original system. So let's break down each of these 4 things to create the system. Number 1, as I talked about, uses the Dow 30 stocks. What we do is we take the worst performing Dow stocks of each year. Now, something about Dow stocks, when they're the worst performing, they also have the highest what? Dividend yields. Okay, so what you're really doing is you're taking the stocks that have the highest dividend yields, because chances are they're going to be the worst performers. And 99% of the time they are. Now I'm taking out of the 30 stocks, we're going to look at it from January to December. We're going to look at the stock that has the highest dividend, which is also the worst performer for the year. And the 5 worst stocks are going to be the ones we're going to be looking to buy in January. Okay, now I'm going to show you a little variation of this after lunch of how to actually make this a little bit better, the system better. But we're just going to take the original system right now. So we're going to reallocate each year. You're going to look at these 30 stocks, and you're going to decide which ones are my worst 5. Those are going to be the 5 I want to look at to be a buyer of. Number 2, the theory behind the system is that the worst performers last year are going to bounce back this year. And if you've looked at this system, it works. Any of you that have seen this, there's a guy that works with us. His name is Dave. He's one of our traders. He also is a teacher. He does this particular system in his account and in all of his kids' trust accounts he's created. And he's done very well. He's been doing it for about the last 8 years. He's done real well with it. And it's amazing because it works equally as well as in good times as in bad. Now I want to show you what kind of performance it's had too. The way the system works is it rewards you in 2 ways. First of all, with the price of the stock actually bouncing back. And then number 2 is that you get dividends with it too. And the dividends have averaged out in the last 10 years of about 5%. So you can take a guess and say, well, whatever the stocks wound up doing, you got to add 5% on top of that, and that's what the entire system does. Here is the dogs of the Dow for 2002 through spring, through around the beginning to middle of June, I believe is what we ran this to. The dogs of the Dow, if you see the 5 for this year, they were Eastman Kodak, J.P. Morgan, Southwestern Bell, International Paper, and Exxon. This was the price at the end of the year, and this was the price just as of last month. Now, those have actually gone down a little bit, which is why I said it was up 6% instead of 8%, because they've dropped 25 from the 8 to they've dropped 25% from their high or from that date, but they're still up rather big. Now, what you have here is, if you look, you got price today and difference, and then the yield is where? What's the yield coming from? Yeah, the first quarter payout, first quarter dividend payout. So that's not bad. In fact, you know what? A lot of people are looking at that and they're kind of salivating because if you're looking at that versus what you may have in your portfolio, that's not looking too bad. The thing is that what we want to do is we want to make it better. So I want to talk about how to make that better. But to recap this is the recap on the Dogs of the Dow system. If I'm giving you the Cliff Notes version of it. It's a long-term stock buying system. What that means is basically every year you're looking to buy certain stocks, and they're the ones with the highest dividends in the Dow 30. Unlimited returns, because if you buy stock, remember what the picture of the stock graph looks like? If you don't, I'll draw it up for you. And then I'll click back to this in just a moment. This is your return on a stock. You have what? Unlimited upside. And you do have limited downside, but what are you limited to? 0. Right. Okay, so, and again, we're going to make this better here. So that was the second thing, substantial risk. And what I mean by substantial risk is that the stock, the dog system the way it is originally, the stock price could go to 0. Now, the actual worst case scenario was 6.8% for 1 year. And what that was actually, I think it was more like about 11% for 1 year. But then what did you get to drop it back to 6? You got about 5% in dividends. Okay, so, and here's the fourth thing which is interesting. Outperforms nearly every fund in the last 30 years. Average annual returns, 22% in the last 30 years. That's not bad. When you look at what, if you could get a 22% return on something that can beat mutual funds, the Dogs of the Dow, that's pretty neat. Now, how can we make this better? That's the next thing we're going to look at.
This concludes CD number 3 of the Optionetics audio series. Let's review some of the most important points. In this session, Tom Gentile introduced an innovative trading system called the Dogs of the Dow. The average trader uses the following methods to find and execute trades: the discretionary method, greed and fear, buy low, sell high, and the religious approach. But successful option traders pay attention to 3 things: news, technical analysis, and systems trading. Most news traders are short-term traders that trade on the information from media reports. Unfortunately, by the time the news comes out, the move has often already been made. Technical trading uses charts and indicators. Most indicators, including moving averages, Bollinger Bands, and stochastics, are based on price. These days, thanks to computer software, there are more than 1,000 indicators out there. So when you find something that works, don't try to fix it. A system trader is someone who may take news and/or technical analysis and put it together to create an objective trading system. The trick is to take a sound system and increase its efficiency by employing creative option strategies once a bullish, bearish, or sideways signal is received. Choosing the right system to fit your trading personality is the key to making a profit. First, you have to decide if you are a directional system trader or a non-directional system trader. Second, are you going to take buy signals or sell signals, or both? Third, you must determine the time frame you want to trade: day trading, short-term, or long-term. And fourth, you have to fit the right strategy with the right system. Now, let's review the Dogs of the Dow system. The original Dogs of the Dow is a long-term stock buying system that involves 30 stocks listed on the Dow Jones Industrial Average. To use this system, start by identifying the 5 worst performing Dow stocks. Usually, these are the stocks with the highest dividend yield. These 5 stocks are the ones you want to buy in January. Why? Because, in theory, the worst performers last year are going to bounce back this year. This system rewards you in 2 ways. The price of the stocks bounce back, and you receive quarterly or annual dividends, which in the last 10 years comes to about 5%. The Dogs of the Dow system, as it stands, comes with unlimited rewards and substantial risk. There are ways that we can increase the efficiency of this system using options. This concludes CD number 3 of the Optionetics audio series. When you're ready, please insert CD number 4. CD number 4, Beyond the Basics continued. Welcome to the fourth CD of the Optionetics audio series. Now, let's return to Tom Gentile's innovative discussion about system trading using options.
So we talked about call options and put options. And what we're going to do is I want to talk about analyzing different positions now. What we do as traders is we do these three things. What if I'm right? What if I'm wrong? And what we do is we analyze risk. Our group loves to analyze risk, and you're going to see that more and more as we go along. In fact, we're going to show you guys some risk graphs in the next 2 days that are just going to blow you away in terms of risk to reward. And you'll see them as they pop up, and we'll have some really good looking stuff. Some of you guys in the room already know what we're talking about. So, as traders, I think if you want to be successful, you want to look at risk first. Because if you look at risk first, the rewards will come. Bullish. For those of you who have never traded before, consider buying call options in place of buying the stock. Because you got three things here. You got the fact that you're going to have lower cost and lower risk. You're going to have the power of leverage. That means instead of shelling out, someone said a couple of UPS comments that came out. UPS is at $67. Now, if you went out and bought 100 shares of UPS, you're going to pay $6,700 in a cash account. However, if you went out and just simply bought a call option with a couple of months to expiration because you think maybe UPS is going to continue to go higher, you'll pay $200 for that. That's the power of leverage. It does come with a price, and we'll talk about what that is, but if you look at the way the stock market's been moving around a whole lot, obviously, being an option trader in the last year, just imagine this. Instead of buying your, let's say January, how much has the market dropped in just this year alone as an average? Does anybody want to take a guess? About 20, but if you looked at the Dow versus the NASDAQ, S&P, a little over 20%. Okay. If you would have instead of taking your entire, let's say that you had your entire portfolio in stocks and your portfolio was down 20% this year. Imagine this. Instead of doing that, for every 100 shares of stock, if you bought a call option instead, and you took the other 90%, so you took 10% of your money and bought a long-term option, you took the other 90% of your money and you threw it into something like corporate bonds or something that could get you, 5 to 7%. And let's say you were dead wrong on all of them by the end of the year. How many of you think the market's going to be lower later on this year than it is right now? I think so. I think we haven't seen it yet, low yet. In fact, there's a certain month I seem to get real scary of. Anybody want to take a wild guess? October. Yeah. Mark Twain used to be actually used to be a stock trader. He was quoted in a paper saying that the worst months of trading were October and April, followed by January, February, March, May, June. Obviously, he was a terrible trader. He was absolutely terrible. Maybe a great writer, terrible trader. But the thing is that you look at October, that's an area where there's a lot of things that come together that cause the markets to be weighted down heavily on the sell side. Plus, the other thing that's happening too is volatility is going higher, so options premium is more expensive. And I had a talk in the back of the room. Someone said, hey, if the markets are going down, how come volatility gets higher? And, without trying to get too technical on volatility this morning, think of this. As we panic, what do we tend to do? Things we don't want to do. Yeah, we tend to do the worst possible thing. And when we do the worst possible thing, that means we might get in or out of something at whatever price we just possibly can. It's like buying hurricane insurance when you see the hurricane right offshore coming your way. You're going to pay out the nose for hurricane insurance. You may pay 3/4 of the cost of your house at that point. And that is equated into options premiums. It's very similar to, I don't want to pick on George, but George likes to have the very first Viper that ever rolls off the line. He's ordered the brand new one, the new 2003 edition, and I'm sure he's going to pay out the nose for that too. Because sticker price is going to be one thing, but when you're the first guy in line to buy it, it's usually what? Several $1,000s over sticker price. And then as it gets absorbed into the markets, it then comes down. Okay? That's the same way with options prices on companies like WorldCom and Enron, and as they made those big drops. Everybody just wanted to head for the exit doors. and they were paying above and beyond normal prices just to get out. Okay? And so keep that in mind as we move along, because we can actually make money in those situations. Getting back to being bullish, buying a call instead of buying stock. You know what? There's certain, like I said, there's certain things out there that we can look at. Gold stocks, silver stocks. You know, GG is a stock that we've been looking at the last couple of weeks, and we're in it right now around $1.50. And it's at about $2.50 right now. And that's another one I think that if we continue to drop lower, you know, this is about a $11 stock that is not hedged at all. What I mean by that is their company doesn't hedge. If the price of gold goes up, GG goes up. If the price of gold goes down, GG goes down. And so being a non-hedged company, it's a really good play if you think the price of gold is going to go up. You don't have to have a commodity account. You can go in and find these particular companies that are unhedged that will move at a rate of speed that could even be greater than the price of the asset itself. So, you know, write down GG, because we're going to be looking at it in the next 2 days. Okay, let's look back at our dogs of the Dow system again. And what I want to look at now is I want to look at possibly buying call options instead of buying the stock. Okay? And I want to show you something here real quick. If we would have bought the stock on December 31st, or actually January 2nd or 3rd when the market opened back up again, this is what we would have done if we're buying 100 shares of Eastman Kodak and IP and Exxon, XOM, and SBC, and what was my last one? JP Morgan. Yeah, this is what you would have wound up paying, JP Morgan. 100 shares of each would have cost you about $18,500 for 100 shares of each one of those stocks. Now, if you would have bought the at-the-money to slightly in-the-money, because, you know, you can't always buy an at-the-money option. In order for you to buy an at-the-money option, where does the stock price have to be? At the money, right? It has to be right there on a strike price. So sometimes it's in between the two. So what I'm looking at is buying at the money or slightly in the money options. You would have wound up for a 1-year option instead of the stock if you would have replaced it with a 1-year option on each. That would have been one contract for every 100 shares, so that would have been one contract of each. You would have wound up paying, instead of $18,500, about $1,850. It was roughly 10% to have that position for the year. And now realize part of that 10% is real, because if you're buying some in-the-money options, you're getting some real value. So I think it was about 8% was the risk, the time risk that you had there, the actual option premium risk. So if you had 8% of option premium risk, guess what you had in 92%? 92% of your account was what? Cash or bonds or whatever else you wanted to do that had a fixed income. Now that's interesting, because you now only have 8% of your account at risk, not 100%. And I'm starting out real conservative here for you, because that's where I want to take you up some building blocks. So we're going to start conservative. And if we look at this graph again, I want to show you the return on investment that owning one contract of each of these would have done for you. You know, and I'm going to use the 8% number because that's what I had as June. 8% in June equated out to 38% in the options. From the price of the options between January and June, we're at 38% for a return on investment. Okay, so that's not bad. It's getting better. All of a sudden, wait a second, we can take a simple system that somebody else is using, and by applying options to it, we get a better return on investment. All right, does everybody see that? You know why we get a better return on investment? Less capital used. Plus, guess what else we got? We got a nice smooth equity line. If all the dogs of the Dow became real dogs of the Dow, you know, a dog becomes a real dog at the end of the year, you're not looking so bad, because you've got what? Well, let's think about how much risk you got out here. You got about, let's say you got 10% risk. 10% risk, okay. Do you get any dividends for buying options? No, you don't. No, you don't. So you don't get that 5% dividend kick. But what do you get if you got a 90% of your money in cash? You get some sort of return. You get that 1% Christmas Club account that you got at the bank. Or, you know, you can get somewhere up of 8% for AAA bonds, for corporate bonds. So, I mean, you could literally end the year out at even or down maybe a couple of percentage points and yet still have the return possibility by buying call options if the dogs of the Dow make that big move up. Okay, so here's how to get that 22% return without all the risk. That's pretty neat, huh? Take a simple system and make it better by trading options. I'm going to show you how we're going to outdo this too, because I'm going to bring this up quite a bit more here. Now on call options, George talked about call options. Here's some notes on call options I want you to write down. Number one, never hold call options with less than 30 days to expiration. This is where I wound up losing money, is if I bought options in the last 30 days. That didn't work real well for me. I was buying 60 to 90-day options, and I was holding them no later than the last 30 days to expiration. The reason why is because you have something called time decay, and I'm going to show you a graph on time decay here before lunch. It's kind of like a snowball. Unless you guys have ventured outside of the Silicon Valley area, snow is that white stuff that you see that falls from the sky when the temperatures drop below 30 degrees. And what happens is, with a snowball, when you roll it down a hill, it might not start off very big, but as it starts to gather more snow, it can become very, very big. Time decay is very similar to that. Time decay can eat you up in the last few days to expiration. So what we want to do is, we want to look at options with less than 30 days. Also, can options be expensive from stock to stock? Yes, they can. You know what? John Deere has options, and let's think of somebody else that has options. Broadcom. Which ones do you think are more expensive, the John Deere options or the Broadcom options? Broadcom. Okay, why is Broadcom more expensive? Well, why is the volatility higher? Because it moves more. Why does it move more? I'm digging real deep, aren't I? It comes down to this, guys. Which one are you going to hear about more on TV? Broadcom or John Deere? Okay, that means Broadcom's being advertised more. If it's being advertised more, people are listening to it and they're making decisions based on that. It's just like anything else. The more something's advertised, the more people are going to react to it. And so you got a lot of people reacting to technology more than they're reacting to farming equipment. Plus farming equipment, it is really hard for a company like John Deere to screw up their account statements. Tractors come in, tractors go out. They come in at cost and they go out at a higher cost, and that reflection is a profit. It's not, where do you hide the tractor, right? So just keep that in mind. Also, what we want to do is, expensive and cheap can vary. And it just isn't in price only. It can be in other areas. And we're going to show you this afternoon how to spot call options that are on sale. And what I mean by on sale is how to spot call options that are cheap relative to where they've been. Call options that we've traded this year. These are call options we've traded this year. They all had one thing in common. We traded them between 30 and 60 days. And as you can see, we don't win on all of them. But if you have a system, I'm going to show you this, our call buying system this afternoon. And what we've been doing basically has just been looking at these stocks. We're going to be looking at one thing, which is higher highs and higher lows. But I'm going to show you the indicators we're using that are giving us these kind of returns. Can you make money trading just call options and put options? Absolutely. And you know what? There's been no better year to do that than this year, because contrary to what's happened in the last week, volatility in a lot of these stocks have been low, meaning the options have been very cheap until just the last couple of weeks. Bearish. Now, we talked about being bullish. I want to talk about being bearish because that's where most of us, if any of you in here are trading directionally, this is the place to have been since March of 2000. Now, was I bearish on March 1st of 2000? Absolutely not. You know why? Because prior to March of 2000, this was the direction of the markets. I'd be lying through my teeth if I told you I got short in March of 2000. There's just no way. I don't know anybody that did, because the markets primarily went like this. And this is March of 2000 up here. Now, we had to do a couple of these before I started thinking, wait a second, doesn't look so good. Where I started getting real bearish was a little known month called October of 2000, because there's something I do in October every year, and you guys that have been back here know exactly what I'm talking about. It is, I like to be short just after Labor Day. Just after Labor Day, I like to start squaring up my positions. And I was getting short Labor Day of 2000, and what I noticed is we didn't, I thought just like everybody else, hey, we're going to go down in October, and then we're going to bounce back, we're going to be better than ever. The only thing is we bounced back, we just didn't bounce back to a new high. We continued to make lower highs and lower lows, and since October 2000, I've been pretty much on the bearish side because that's what the trends are telling us. Now, how many of you have shorted stock in this room before? Any short sellers? More than I've ever seen in a seminar. Okay? But here's the thing. Still, the minority of people in here probably don't even know how to sell stock short, let alone want to do it. In order to sell stock short, the first thing, what's the number one thing you need to sell stock short? Money. Right? A lot of money. Yeah, you need, depending on your broker, you need to have a lot of margin money because what if you're wrong? What if you sell a stock and it starts going up? Then you've got to buy it back higher. And there really is unlimited risk when you short a stock, especially if you short the wrong one. So you need margin, you need money. The second thing you need to do is you got to have a little bit of knowledge that you can sell something before you own it and then buy it back cheaper, which is a hard concept for people to grasp in the beginning. So how about buying a put option instead of selling stock? Because it's going to be what? It's going to be lower cost, it's going to be lower risk, it's going to have the power of leverage just like the call options, and it has the power of protection in case you are dead wrong. So these are some things that we need to look at, is we need to look at this possibility. And I've done a lot of put options and a lot of bearish type of trades even just this year. I haven't changed my trading philosophy in the last 2 years now, coming up on October, is remain mostly bearish because that's the way the stocks are, the market, overall market is reading. And until it does something else, I'm going to keep doing what I'm doing. What I want to look at for a system here, this is a very good system I'm going to show you. Now let's do a little recap. We learned a long-term system using the dogs of the Dow. It's a once-a-year system. It's a great system, but what are you going to do the other 11 months out of the year? You're going to wait for January to come around and do it again? Yeah, you know what, you could. You're going to make great money doing it. But what about the other 11 months out of the year? If you want to be a trader, you need to find some other systems that work outside of that. How about a Dow selling system to complement our Dow buying system? The only difference is this time we're not going to use stocks in the Dow. We're going to use the options on the actual Dow index itself. This is primarily what I do. I trade primarily index options. There are reasons why. I'm going to go over them with you in the next 2 days. There are some excellent reasons why you want to trade index options. Let alone, the first one is if you're tired of trying to figure out where an individual stock is going, you can trade a basket of stocks, which is called an index. This is the Dow. You can use what's called, there's two different indexes here you can trade. You can trade what's called DJX options. Those are options on the Dow. Or you can trade the diamonds. Okay? And the diamonds are basically the same thing, options on the Dow. I traded DJX options. The symbol is DJX. It trades at 1/100th of the price of the Dow. So if the Dow is at 10,000, the DJX is trading at 100. And if you were going to buy puts on the Dow at 10,000, you would buy DJX 100 put options. It's very simple. You just take 2 decimals off, and you're trading right where the Dow is. So where's the Dow at today? Where did it close? 8,000 and something, right? Okay, so guess what the DJX put options are going to be if you want to trade the ones that are close to the money? 80s. Yeah, 80 puts. Okay, that's your DJX option. So we're going to use options on the Dow. We're going to buy the 60 to 90 day at the money put options. It's a short-term system, which means it has a time stop. That means we're going to get in, and then 30 to 60 days later, we're going to be out. That's your time stop. If I use a 90-day option, remember what I said about options? Don't trade them in the last, what? 30 days. So if I use a 90-day option, I got 60 days to be in the trade. If I use a 60-day option, how many days do I got in? 30. Great. So I have a time stop of 30 days or less. Well, we got to use, so I've shown you a great system, but when do you actually put it on? What's the trigger? What's the trigger that tells me, Tom, we're in? All right, here's the trigger. The trigger is a little known indicator called the VIX. VIX stands for Market Volatility Index. It is a gauge of human fear and greed. That's exactly what it is, guys, and it's chartable too. And we're going to talk about where you can find this and how you can put this together, and you're going to see some really staggering results with this thing. This is a really good system. It isn't even my best. and it's a great system. What we're doing is we're going to buy 60 to 90-day put options on the Dow when the VIX drops below a level of 20. Exit the trade within 30 days to expiration. Do you know that 2 months ago, almost to the day, the Dow dropped below 20? The VIX dropped below 20? That was when the Dow was up there near 10,000. Where's the VIX at today? Yeah, it's above 40. Which, you know, as the VIX goes higher, what usually happens with the markets? They go lower. And when the VIX goes lower, what's happening to the markets? They're going higher. So the VIX is a gauge, is pretty much a sentiment gauge. It means that when it drops below 20, what is the herd doing? What is the cattle out there, the cattle investors doing? They're buying, right? And that's when we need to be doing what? Yeah, we need to be putting on a hedge position or puts or protection or something, because something is likely to happen. And what we're doing is we put the trade on when the VIX drops below a level of 20, and we're going to exit the trade 30 days to expiration. So let me show you a chart. These are two charts. The VIX, by the way, you can get off of our website. That chart up on top, that first chart you see is the Dow Jones Industrial Average. The chart on the bottom you see is called the CBOE Volatility Index, or the VIX. Now, if you want to key these into our website, this is how you got to do it. I'm going to write the symbols down for you, because if I don't show you this, then I know somebody's going to get a lot of calls next week, and it doesn't need to be, because they'll blame me for it. $ INDU for the Dow Jones, $ VIX for the VIX. Now, why $? Because the $ on our website represents that it's an index and not a stock. There's like $ SPX would be the S&P 500. But if you just typed in SPX, guess what you're going to get? SPX company. There's a company out there called SPX. And you might say, wait a second, the S&P isn't at 50. If the S&P is at 50, we got more problems than you think. All right? So these are the way you want to key these particular symbols in. Now, let me go back to the chart again, because I want to show you some interesting things on this chart. The red arrows that I have on here were every time that the VIX dropped below 20. And above was where the exact same point you would have been selling or buying put options on the Dow. So I had one right here, which didn't really result into a big move. I had another sell signal here because the VIX dropped below 20. That had a nice little move down of about, I think it was 300 points or so, 300 to 400 points. Notice here that in the year 2001, the VIX was never below 20. So guess what we didn't get? We did not get a signal in 2001. 2002, though, we've had two signals almost back to back. And the first one resulted in a 400-point drop, and the second one, which came on just after this chart, resulted in a drop of how much? Thousands. Yeah. Yeah. So let me show you the results of this system in the last couple of years. This was 1998 to 2002, 4 years. And by the way, I could go back to 1987 for this data, and it shows the exact same basically win-loss results, because that's as long as the VIX has been actually able to be tracked, is 87. In fact, the VIX just tells us normally what's going on out there in the market environment. It's almost like a Richter scale. Okay, when it's low, chances are it's going to tend to go higher in the future. When it's high, chances are it's going to tend to go lower in the future. And it's a representation of options traders, okay, because it's implied it's volatility. But you think of it as fear and greed, okay? And let me just drop back here, and I'll talk about this in a minute. I'm going to back up a second. Look at this. When the VIX is high, it's time to buy. You know what that means? Look at this spot right here. When was this? September 11th. Yeah, just after September 11th. Look at the market. When the VIX is high, guess what it's time to do? Start buying up the market. And we did just that. The week after this happened, I was over in London, and I was on Bloomberg. And there was a couple other guys who did a little panel thing. And the guys that were on Bloomberg were worried. They were saying, oh, my gosh, sell everything you own. And then they asked me, well, what do you think? And I said, well, looking at these two guys, I need to get on the phone right now and buy something. They didn't like that. They were funny mentalists is what I call them. And so they were worried about the markets, the overall, of the markets. I said, well, I think between September or October and March is the best time to be a buyer. If you go back in time and you look at that 6-month time frame, you'll know exactly what I'm talking about. And this was exactly the same thing that happened again. I mean, between that October and March area, we had a nice move back up. I told him, I said, I thought the Dow was going to come back up to around 10,000 to 10,500. That's exactly what was said. You can actually go back and see it. Go to Bloomberg and go into their archives, and you can find me in that nest of pickings there somewhere. But anyway, what I was talking about was when the VIX is high, it's time to buy. Well, what is considered high? Anything above 40. When the VIX is low, it's time to go. Okay? You know what that means? That means go get out of anything you're in, or buy puts, or, you know. Is that confusing, what I just said? When the VIX is high, it's time to buy. That means what? That means look at call options. That means look at going long. When the VIX is low, notice here, low VIX means that we're going to have a lower market in the future. Low VIX, you know, and this one obviously did not work, and I'm going to show you that on the screen, the next screen, where we had that was the one loss we had in the last 4 years. But you know what happened here in this case, where we've had these big drop downs. There is a roughly, I want to say 80% of the time, when you use this over the last 15 years, you have a winning system. And what is the system again? When the VIX drops below 20, what do? You look at buying put options, because guess what? Number one, they're cheap. Because when the VIX is low, options in general are cheap. When the VIX is high, options in general are expensive. Where's the VIX now? It's high. So options in general are expensive, but not all options are expensive. You know, when I say in general, we're going to find the ones that are real cheap right now. And we're going to talk about those. But the thing is that the overall market right now is very expensive. So what are we going to be looking at to do now? Well, I'm going to talk about that when I get to it. Yes, sir.
You do only on the Dow, or you can do on the S&P?
Good question. His question was, could you only do this on the Dow, or could you do it on the S&P, the QQQ, the OEX, the NDX, and every other index? And the answer is you can do it on any index you want. Now, there is one more, I'll give you this. There's one more VIX-type indicator out there. It's called VXN. VIXN is the way it's appropriately called. VXN. That is the market volatility index for the NASDAQ. They pretty much, if you were to take one and put it over top of the other, kind of in transparency, they ran about the same. So you could just use this one and it's just as good. The one thing about the VIX, which is different than the VIX-N, is it has more data. The VIX has more data. Yes, sir?
Is it always 20, or is there something magical about 20?
Is it always 20, or is there something magical about 20? What I've learned about 20 is that when it goes below 20, it doesn't stay there long. Now, I'll tell you this, back in the early 90s, the low on the VIX was 8. So go figure, you know.
Is it the same from index to index?
Oh, is it the same from index to index? No, it's not. You have to look at the VXN and find out where its bottoms are. But with the VIX itself, 20 seems to be a real good level to be a buyer of these put options if you're going to trade the system the way that I do. You had your hand up next. Could I possibly use a filter for that? Here's a good filter. When it crosses back above 20, make it your buy. You might be laughing, but that's exactly what you can do. Is it, you know, sometimes it could linger below 20 for some time, and on the last 4 years it is not. But if you look back to 1997 and 98, I think it lingered below 20 for a month. And so, but when it crossed back above 20, it was like, better jump on the train because it's moving. VIX system 1998 to 2002, 713.98. There was the VIX level at 1688. Now I realize that as these move, you know, this one took a little while, but once again, as they cross above 20, they continue to move higher. Within 30 days, the Dow dropped 1,000 points. Puts returned, the at-the-money puts returned 200%. So basically, whatever you put in, you got twice as much back. Next, the next signal came on 7/12. Interestingly enough, very close to the last signal. It was at 1813. 30 days later, Dow dropped 1,100 points. Now here's the one in the last 4 years that lost. 11/15/1999, the Dow dropped below 20. Well, the S&P actually rose 300 points 30 days after, but you wind up losing $1 on that trade, doing the DJX options. So that's the one area that we got the rise up. On 8/21, you had a VIX that was below 20. Dow dropped 1,200 points. On 325, the Dow dropped 800 points 30 days after, when we went from 1925 on the VIX up. And then the most recent one was on 5/20/2002. The Dow dropped below 20. Actually dropped, that was the close, but it dropped a little bit farther below before it closed. The Dow dropped 1,000 points over the 30 days, and you know where it dropped after that. I just took the 30 days after the trade came out. So, is it a good system? Absolutely. When does it generate the most signals in the last 15 years? Around Labor Day. That's something worth writing down. Because where are we at right now? We're in the end of July. Could the VIX drop down below 20 between now and Labor Day? Yeah, but there's going to have to be a whole lot of nothing going on, okay, for it to do that. I wouldn't put all my money on the fact that it could do that. I'm going to show you later on over the next 2 days a system that works 96% of the time using this particular strategy. A sell system recap. Unlimited returns, because that's what you get with put options, at least all the way to zero. You get unlimited returns over the course of the 300% in 1 month is what is the best that we came up with. Limited risk. Actual worst risk in the last 4 years was 1 point. And once again, this is exactly the same pretty much in win-loss ratio that's happened ever since you could calculate the VIX. All right. I wrote George and I both wrote a column in Barron's Magazine just a couple years ago in October called October Witch Project, where we actually pointed out that the majority of the time between September and October that the VIX will rise. Now, what does that mean? That means that the majority of the time, what happened to the market between September and October? Yeah, it fell. And so now those of you know exactly what we do with it. We didn't get that deep into the program, but I talked about, for instance, option premiums over the last 15 years. If you look at between Labor Day and the end of October, option premiums jumped an average of 20% in that time frame. Now, how many of you know what time decay is on an option? You know, you buy an option and it doesn't go anywhere, what happens to the premium? It starts chipping away and could expire worthless. Well, if you get into a situation where volatility is going up, what does that do in the time decay? It's kind of putting it on hold. That's the best time. You know, you could be the stupidest options trader on the planet. You know, that's going to have to be edited. Sorry. You could be the worst options trader on the planet, and if you simply bought options after Labor Day and sold them at the end of October, you'd have a pretty decent system going 15 years back. Okay, so I want to throw that out there for you and let you realize the importance of looking at that September-October area. Now, last year that didn't work so good. Why is that? Because there were events that happened in September that no one knew about, and it caused the market to do what? Drop like a hammer. Now, there's something that happens in October also. I'll go through the whole October regime with you. In October, what happens? We have quarterly earnings that come out. You know what else happens? Hedge fund managers close their books for the year. And what they do is basically this. If you run a hedge fund and your year ends on October 15th, what are you doing between the 1st and the 15th? Because a hedge fund, you have to, your clients are taxed. It's not a mutual fund. You get taxed every year on the gains. So what are we doing as hedge fund managers to try to help avoid as much tax as possible? We are selling off losses to do what? For tax loss reasons, to lower that taxable gain. Well, you know what? If you're the average hedge fund manager going into last year, and the markets were down, and the majority of stocks that you owned in your hedge fund or stuff you had in your hedge fund was worth less than it was when you bought it, what are you not going to have to do in October? You're not going to have to sell anything for a loss because you have no gains. Reason why October didn't drop last year is because there was no reason to sell. Everything was it was always so low. There was no reason for anybody to sell off, any institutions or hedge funds to sell off gains because they didn't have any gains. Hence, that's why you saw that October move to do what it did last year. But if you look at the majority of Octobers, you'll see that they are generally selling months. Additional notes, again, don't hold put options with less than 30 days to expiration. And what we're going to do is show you how to spot these put options that are on sale. These are puts that we've done, kind of the same situation here. I mean, you know, Cisco, I'm looking at some of the more recent ones we've done just in the past couple months. Cisco, Charles Schwab, Eli Lilly, CVS, Merck, Rig, Baxter was just one we did last week. But, you know, if you have a system that works, and I've shown you 2 of them already, you know, you can come up with you know, can you make money in calls and puts? Yes. Here's the way you make money in calls and puts. You don't drown them out to where you're in them longer than you need to be, okay? We have a system that's a 30 to 60-day system with calls and puts. I'm going to show that next. But what we do is we try to put these things on, and we're out of them by when? The number one rule is we get out of our put options or our call options by 30 days to expiration, because that's where you hold the most risk. That's where you have the most directional risk and the most time risk. In the beginning of an option's life, you have more direction than you do time. At the end of an option's life, you have the more time risk than direction. But if you happen to, I mean, regardless of whatever you're holding, if you're holding a call or a put, your directional and time risk get very big at the end of expiration. Now, write these 2 stocks down, because we're going to be looking at these just after lunch. UPS is one of them, and Sony, S-N-E, is the other one. All right? I want you to think about these. Think about which one, you know, what we might consider doing, because when we come back, I'm actually going to get into comparing prices on these and look at entries and exit strategies. Here's UPS. I want to just quickly show you this chart. I'm going to show you kind of what we do for comparisons. You know, if we look at a stock that we like, to the upside or that we like to the downside, this is where we take, you know, I've talked about systems. I've talked about how to employ systems. The next thing that we do is once we find a system and we find something that works, we then move into strategy mode. Which strategy is going to work the best for that system? And so when I'm looking at a particular system where I'm going to use options, then I've got to look at time decay. Did George talk about time decay? Yes, he did. Let me graph it out for you and kind of show you what you look at. Leap options, if I looked at all these type of options, a leap, a 6-month option, a 3-month, and a 1-month option, which one's going to cost the most in dollars? Leaps. Exactly, because you're buying more. I mean, it's just like, you know, it's like going to Costco and buying you go to a 7-Eleven. Do they still have 7-Elevens here? Okay. I see them getting gobbled up in the other parts of the country. But you go to 7-Eleven, and let's say you go in there and you're looking for a can of Spam, okay? Now, Spam isn't something I eat, but I see it on the shelves of convenience stores all the time. And, you know, it's that little can where you don't see it till you blow the dust off of it. But if you were to buy a can of Spam at the 7-Eleven, it's going to cost a lot of money. If you went to Costco and you bought a whole case of Spam, if you looked at it by the can, it's going to be considerably cheaper than the 1 can you got over at 7-Eleven. All right? You know, when I said this, I did this in New York, and when I said this in New York, nobody got it. They couldn't understand it. And I said, all right, let me give it to you in other terms. And I said, you see that car that's over there that's stripped down across the street on the side of the road? I said, you know, somebody stripped that down for a purpose because they know the parts on that car are going to be much more expensive than the sum of that whole car together. And they all went, oh, yeah, we got it. I'm like, oh, wait a minute. What am I dealing with in here? And where's my car? So as we move along, here's kind of what we're looking at is that, you know, these 3 months of an options life are fine to get into, or these 3 particular examples. If you're buying a leap option, you're buying a economical value. You're buying a good quality option. If you're buying a 6-month or a 3-month option, that's fine too. When you get into that 1 month, that area where you're buying that 60-day to 1-month option, you know, you're getting into what I call the red zone. And that's an area you want to avoid. All right? Mainly because of this. Look at the slope that you lose in time decay in the last month. It's just like that snowballing effect that I talked about. So stay away from the 30-day options. Now I'm going to compare. I'm looking at UPS as an example here. I want to compare 100 shares of stock at $67 a share. Now what I also did was I went out there and I looked at the 65s and the 70s. I looked at the 70-day, 90-day option, and it was trading for 2. So to buy 100 shares of stock is going to cost you $6,700. To buy an option that's very close to the money with 90 days to expiration, you're looking at paying 2 points for. The January 04 option was going for $6.20 or $620. Now, if you look at the time decay on the 90-day option, you know, obviously right here, which costs the most? The stock, the 90-day, or the leap? the stock. And then the leap is second and the 90 days third. So, but if you look at time to value on these two, which one's really the cheapest? The leap is, because you're on that part of time decay where it doesn't slope off that much. And so you're only losing $18 a day on the leap option versus $67 over the life of the 90-day option. So, my question is, which is the cheapest? We know it's the 90-day option. Wouldn't it be nice to get the leap option for the same price as the 90-day option, or even cheaper? Yes, and that's what we're going to talk about. Okay, so that's something we're going to get into after lunch. Is called spreading, where we can actually spread off our cost and our risk with some creative financing. What we're going to do is we're going to trim the cost of our trades. That means what we're going to do is further reduce the cost and risk. We're going to reduce the break-even on the trades, and we're going to increase the return on investment. Okay? Now, if I reduce my cost and my risk, let's say that I can take that UPS trade. Instead of buying that one for $670, I could actually buy that leap option, and with some financing, I can get that leap option for less than $200. That's a good trade, because now I've got the best of both worlds. I've got the real cheap price, and I've got how many months to expiration? Yeah, a year and about 6 months. So instead of 3 months, I've got 18 months to expiration for less than the cost of the 3-month option. Now, the other thing I talked about was reducing the break-even. Well, if the cost is cheaper, you're going to be closer to your break-even come expiration day. Also, increasing the return on investment. Obviously, if you lower your cost, you stand, most cases, better than all, to be able to increase that to a triple-digit return. Last thing is smoothing out the equity curve of stress. For those of you, who are the traders in here? Again, who has been trading in the room? Raise your hand, please. All right. Everybody in this room has gone through at least one period in their life where they've had a little stress in their trading. Some of us more than others. Okay, I remember my day when I did it. It was 1987. And even it was before then, too. I'll tell you when it was before, when I was making money, because I was making so much money I couldn't sleep those nights either. Me and the ceiling had a very intimate conversations at night, and they were all the same. What am I going to do tomorrow? How many of you have had that problem? And probably did something stupid like me, and I went from being up really big one day to being down really big the next day, and I'm just recalling things that I did as a novice trader that I'm trying to keep a lot of you from doing. See, you know what the best thing about being new in this room is? You come in here without what? Baggage. You're not bringing any skeletons from your trading closet in here, and a lot of us in this room and sometimes wish that we could have started out the way that you are that are brand new in here, because you're going to save yourself thousands and thousands and thousands of dollars in stupid mistakes. Here's the dogs of the Dow with something I'm going to teach you after lunch. And all we've done here is we've done some financing, and we've brought the cost of these dogs down from 18.5 down to 11.5. I could actually even make that cheaper than that. But look what it did to our return on investment. We went from an 8% return to a 30% return to a 92% return by simply changing what? Did we change the system? No. All we changed was the strategy. And it made a big difference on our bottom line. Like I said before, less than 2% of the traders out there know what it is that you're going to learn, that you're learning right now and you're going to learn by tomorrow afternoon. Less than 2%. Now, what I want to do with you after lunch is I want to talk about visualizing your risk. And we talked about, what did we do with visualizing risk so far this morning? We talked about this. I think George probably mentioned these 6 graphs. And I'll put them on this one. What was that? Long stock. Okay. Short stock. What's that? Long call. Wow. That's almost looking like a put ratio backspread, and I didn't want to do that. But yes, long put. Let's make that look a little bit better there. There we go. Don't tell George I knew how to do that, or I'm in trouble. Okay. The last thing is, we also talked about a short call, which looks like this. And by the way, I did these. When I started trading, I actually started trading at the American Stock Exchange. Because I didn't start there, but I really wanted to get the knowledge, so I went in there and I got into that crowd. And that crowd's no different than any other crowd that's out there trading, because do they know that much more than you and I? No. The only thing is they're just trading faster. And I walk around the pits and I kept hearing, options are meant to be sold, options are meant to be sold. And finally it stuck, unfortunately. And I started doing those things right there in the biggest bull market of our lives. And I would sell these things and I'd buy them back more expensive. And I did this for about 3 or 4 months and got kicked in the head a few times enough to realize, well, wait a second, options are not meant to be sold without some sort of hedge. And then the last one that George mentioned was this. And what is this? Short put. That has caused more margin calls. That one strategy right there, which we will not teach you, has caused more margin calls in the last 3 or 4 years than I've ever seen in my entire 15-year trading career. Short puts, because what it did was, it wasn't so much the actual strategy, it was applying it to certain stocks and getting the type of leverage that brokerage firms were letting people leverage up 5 to 1 on those things. You know, margin account will let you do 2 to 1 in stocks. There were brokerage firms letting people do 5 to 1 on these, so that, for example, if you sold a put on a $100 stock and you leveraged it up 5 times, you were out of money if you drop below that number right there, 80. And so, you know, you can see where the margin calls were coming. I mean, imagine this being Qualcomm. These are things that happen. I got a few more that I want to go through with you as well. But I want to talk about how to visualize your risk. We're going to talk about how to take these and put these together. We can put a couple of these together. We can put these 2 together. We can put all these combinations together. And the only reason we're putting them together is because we're looking for one thing: lower risk, lower risk, lower risk. Because if you can get your risk down real low, you know what it does? It takes you out of the emotion of trading, and you become more like a businessman. Okay, and when you think of this more as a business instead of a gamble, then you're going to consistently make more money. All right, the other thing we're going to talk about is how we can do this. We can slash our risk down 90%. Okay, cut your risk more than 90% doing this. I want to show you some more systems, some more system trading that you can do the other 11 months out of the year. Because if you see, the 2 systems I showed you, as good as they are once a year to twice a year trading systems. So I want to show you the ones that you can do every day. Where can I find stocks to trade every day? Yes. There may be some times when I look at some, you know, like we were looking at some last week, and a couple of them didn't have options on them. The stocks look great to sell or to buy, but when we went to go look for calls and puts, how many of you done that? You looked at a stock you really liked, and then you looked for options on it, and you just couldn't find any. Okay? Hey, it's going to happen. I want to show you a couple of tests that I want to run you through, good and bad, of what you're going to experience when you're doing this as a trader. Also, what we're going to do this afternoon is we're going to get into debit spreads. We're going to get into credit spreads. George is going to talk about how to actually put money in your account. Last thing I'm going to say, and then I'm going to cut you guys for lunch, is, you know, let me see a show of hands again for those of you who've never traded an option in here before. Yeah, that's most of the people in the room. You know, amazingly enough, and I say this to you, you know, we think outside the box, all right? I'm a contrarian trader. What that means is that I trade against the herd. I don't do the buy, sell, or hold thing. I don't listen to what somebody on TV who doesn't trade for a living but is really an analyst is telling me. This is stuff that, you know, those of you that are new, this isn't something we just started preaching. We've been talking about this for 10 years now, and we haven't changed at all. It's just that now it's becoming more apparent that, you know, I saw something on CNN that said the average investor needs to start taking a look at their own account. And, you know, the thing is the average investor going to be that much better than a money manager? I don't know. I think that, you know, in order to be better than a money manager, you got to have a couple of systems in your pocket, and you need to have the right strategies for trading those systems. You know, it's been said 1,500 years ago, the majority of the people in the world thought the earth was the center of the universe, right? 500 years ago, everybody thought the world was flat. And about 5 weeks ago, most of you in this room thought the only way to trade was to buy low and sell high. Okay, I hope I've shown you a couple of things here this morning. If from what you've seen, you haven't seen anything yet. Go have yourself a good lunch. Don't eat too much, because we got a lot more to cover. Thank you.
In this session, Tom discussed how we can increase the efficiency of the Dogs of the Dow system through the use of options. For example, instead of buying the stocks, you may want to consider buying at the money or slightly in the money leap call options. These options offer significantly less risk and provide you with higher leveraging power, i.e., more bang for your buck. So, by applying options to the Dogs of the Dow system, you get a better return on investment because buying options requires less capital. In addition, never hold on to a long call option with less than 30 days to expiration. Now, Let's review some bearish strategies. In a bearish market, you may want to buy a put option instead of selling stock. Buying a put option gives you lower risk, and since it costs a fraction of the amount that it costs to buy stock, buying a put option increases your leveraging power. What about a bearish trading system? One system is composed of buying put options on the actual Dow index itself. In this system, we want to buy at-the-money put options with at least 60 to 90 days to expiration. The Dow Jones Industrial Index, or DJX, has options that trade at 1/100th of the price of the Dow. Thus, if you were going to buy DJX puts and the Dow is at 10,000, you would buy DJX 100 put options. Once again, always exit the trade at least 30 days before expiration. This system is best implemented when the CBOE Market Volatility Index, or VIX, drops below a level of 20. Why? Because when the VIX goes higher, the markets usually go lower. This relationship gave rise to the phrase, when the VIX is high, it's time to buy, and when the VIX is low, it's time to go. A high VIX is around above 40. A low VIX is below 20. Another excellent sentiment gauge is the Vixen, or VXN. Whereas the VIX is a volatility index for the CBOE, Vixen measures the NASDAQ. For the most part, these two volatility gauges follow similar paths. A quote or chart for both VIX and Vixen, as well as almost any index or stock, can be easily accessed by keying in the correct symbol in the box on the left-hand side header at the Optionetics.com website. Always remember to add a $sign as a prefix to any index you wish to look up. This concludes CD number 4 of the Optionetics audio series. When you're ready, please insert CD number 5. CD number 5, High Profit Low Risk Debit Spreads. Welcome to the 5th CD of the Optionetics course audio series. In this CD, Tom Gentile will have an innovative discussion of vertical debit spreads.
What I did was had a little crowd up here, and one of the things that came up was looking for these DJX options and these and the VIX, and where can you find these? Let me just show you real quick where you can find this stuff on our website. And not to be biased, but because I use my website more than any other website, it's just real easy for me to find. So where I'm going into is Optionetics.com, and at the very top of the screen, I've got several different tabs here. I'm just going to the Market Data tab, and then what I'm going to do is I'm just going to type in this area, I'm going to type in $DJX. And then right here I can click on Chart or News or an option chain. I'm just going to get the chart real quick first so you can see the chart. And here's my chart. Now, if that's too small for you, I can come down here, and it's small now, but I can make it huge. Large, larger, largest, huge. Okay? Now we'll see what huge looks like. And huge will fill up the whole screen. So there's my Dow chart. All right, if I want to look at the options on the DJX, then I can just quickly change to an option chain. And here's our option chain. And now my options chain is going to be segregated by a couple of different areas here. Let me explain what you're looking at. I got my strike price down the middle. On the left-hand side is the call options, and on the right-hand side is the put options. So if the DJX closed at 80.19, then the 80 calls and puts are going to be at the money. I mean, it's very, very close to at the money. So, if I want to see what are the August 80 calls trading for, then I would look here where it says August 80, and I'd notice that we had a bid of 320 and an offer of 350. And there's 163 open contracts. That means that there's 163 contracts that are open right now. That means that 163, not people, but contracts are open yet to be closed. That means somebody's in the trade that's got to get out. Now, are they in long or are they in short? Yes, right? Some could be long, some could be short. Half of them could be long and half of them could be short. Someone could be doing covered calls and someone could be buying calls. In essence, they're both opened positions. Okay? Now, and I'll show it to you over here, 320 by 350. Now, if I wanted to look at, let's say I wanted to look at a longer term option, then what I could do is, I forgot to tell you about the little thing that you've got here when you came back. Here's September's. The September 80 calls are 420 by 440. And we've got, let's see what other months we got to work with. December, and we've got March 03, and we got June 03, and December 03. So, I mean, there's plenty of different option strikes out there that you can be looking at trading. For the VIX, I can do the same thing. It's just $VIX. Now, I thought what I would do, I took a couple of these and blew them up, made them real big so that everybody in the room could see them. Because I've got a little test for you now. UPS, all right, $67. I told you to think about this during lunch. You couldn't think much of it other than the fact that it's bullish unless you guys went to Internet Cafe for lunch. You weren't able to do too much, so I had to do a little bit more work here for you. All right, I got it at 67. Now, I'll tell you later why I have a target of it at about 80. Okay, but that's my target, is 80. And what I want to do is I want you to look at these 5 options. I just picked off the January 04s. And by the way, if you haven't already, you might want to introduce yourself to the person sitting next to you if you don't know them, because that's going to be your trading partner, the person on your left and right. All right? For this and any other quiz I decide I'm going to give you today. Now, your job, should you choose to accept it, is that I want you to take a look at these options, and I want you to say, now realize, keep that in mind, 80. Keep that number 80 in your mind, because that's what we're using as a target. And I want you to go and look at these, and you and your partner next to you pick out what you think is the best call option to buy. And you know what you need to do? You need to come up with risk, reward, and break even. All right? Because that's what we look at as options traders. When I pick a call option, I want to know what's my risk, what's my reward, what's my break even. Draw the risk graph too. All right? How hard is it to draw a call option risk graph? Well, you just got a blueprint that was handed out to you. So what I want you to do for the next 5 minutes or so is I want you to take a look at this options chain that I have up here. Take a look at the options chain. I want you to pick the call option that you like the best based on what I think is going to happen to the stock. Is it's going to go to 80. And then we're all going to talk about it. So I'm going to give you 5 minutes or so to pick the best one. I'm going to get a show of hands afterwards to see who picked what. I'll tell you what I like, and I'll tell you what I don't like. You may...
Where's the premium?
The premiums are right there.
Why is the bid higher than the ask? Yeah, the bid is higher.
The bid is higher than the ask. Oh, I know why. Maybe because the market was going so crazy on Friday that bids and offers were off. Good point. I want you to look at the offer. Yeah, I want you to look at the offer. I think also because the offer is going to be the right price. I pulled these today. Had I pulled them on Friday while the market was open, I think I would have got a little bit better reporting. So I want you to look at the offer, pick the best one you like, and I'll call time. Go ahead and begin. I hope this wasn't too hard. Let's start off. Let me get a show of hands here real quick on who picked what. Did anybody who picked the 60 calls? The January 04 60 calls? About a dozen people. Who picked the 65 calls? Okay, a little more. Who picked the 70s? A little more. 75s? Anybody pick the 80s? Okay, why did we pick the 80s? Cheapest? Let's go through each one of these. Because if I expect the stock to go to 80, this is the way I look at it. If I pay $9.70 for the 60 calls, that means that basically I'm risking $9.70. If we get to 80, what's the minimum amount that option is going to be worth? 20. Because a 60 call is going to be worth 20 points if the stock gets to 80. It has 20 points of real value. It gives you the right to buy the stock at 60 when it's already trading at 80. So you have a 20-point gain there, less what you paid for the option. If you paid $9.70 for it, that gives you a return of what? $10.30. So you're risking $9.70 to make $10.30. I like 3-to-1s myself. So that didn't qualify for me as a 3-to-1. Next, 65. I'm risking $6.70 to make a possible return of 15, which gives me a profit of what? $8.30. So, didn't I say use the offer? Yeah, that's what I thought I said. I said use the offer price, okay? Oh, that changed a few risk rewards, didn't it? Okay. I'm using the offer price, and even though the bids are a little weird on there, I'm still using the offer price because I know that is going to be the right price. And you know what? This is a rarity that you're going to see something like this where the bid's higher than the offer. But you know what? It was a rarity that you saw what you saw on Friday too, which is why when you see the markets moving around the last 15 minutes of the day as much as it did, it's going to screw up your options quotes. I don't care what service you're looking at. Let's look at the 70s. 420 to make what? Yeah, 10 less 420 is what? 580. So we're not going much above the 2 to 1 on any of these. The 75s risk 245 to make 255. The 80s, if I think it's going to go to 80 and I buy an 80 call, I got a problem, don't I? Okay, so out of all of these, the worst one to pick is the 80 calls. Because they may be the cheapest, but the problem is if it takes till January to get to 80, you're going to see that $1.55 reduced to a level of 0 unless it goes above 80. So I put that out there because, you know what, there are some of you in the room that, you know what, I like UPS. I think it's going to go up, but here's the problem. There's going to be some stocks you like to the upside, and you're just not, or the downside, and you're just not going to be able to find something that gives you a good risk-reward example, or a good risk-to-reward trade. Now let me show you something else that could happen. Here's a stock, MTSC. I like that one. I like that one to the upside. Only one problem. What is it? There are no options available for this ticker. All right, that's going to happen too. Because if you're an options trader, you're going to find stuff that you're going to just going to be looking at. The chart looks good, your projection looks good. You go to look at the options and they're not there. Or worse yet, how many of you were trading options in the late 90s when you were trying to find something to buy and you couldn't because the stock was going up so fast, it was outpacing the option strikes. You couldn't find anything near the stock price because it was moving so fast. These are things that you'll find that will happen. And then you'll run across something like this. All right? Sony Corp, 46. These are put options. Same thing again. I'll give you 5 minutes. Find the best put option. Risk to reward, whatever you like that you find suits your risk to reward. Oh, by the way, where do I think Sony's going? 25. Okay? Take a look at Sony. And it's not because of Michael Jackson and his last his thing with Sony. It's much deeper than that. Take a look at those and tell me what you like. I'll give you 5 minutes on that, and then we'll look and see who did what. Okay. I got one question for you. Did this look better than the UPS? Absolutely. This is some good-looking stuff here. So what we want to do is look at each of these, and we want to determine the risks to rewards on them. And what I've already done, well, let me ask this question. How many of you like the 50s? Okay, a couple 50s, 45s, 40s, 35s, 30s. Okay, majority of you like the 35s and 30s, and I'm pretty sure I know why. Doesn't take a rocket scientist to figure that one out. But here's what I did. And this is kind of what we do is that, we look at each of these, and I'm looking at Sony, and I'm looking at 46, today's price, and I'm looking at my target at 25. Now, the 50 puts costed $640. So what I'm doing is I'm saying, all right, from 50 to 25 is 25 points of movement. Minus the $640 is going to give me a reward of how much? $18, $18.60. Now, what is the risk to reward ratio here? Looks like about 3 to 1, doesn't it? Pretty close. All right, we'll ballpark it and call it 3 to 1. 3 to 1. Now, what's the break even on this trade by expiration? How far does Sony need to drop? It's $50 minus what you paid for the spread, which is $6.40. So your break even is going to be what? $48.60, right? Okay, so I'm sorry. 40, yeah, 50 minus 640, 48.60. Where did I come up with that? Hey, edit that out, would you please? We're traders. We can make mistakes. Yeah, you take $6.40 minus 50, and that gives you a level of 43.60. So that's your break even. The stock's at 46, so look at where it's got to go. It's got to go down less than 3 points, and you're already at break even. So that's something to be said for more quality options. Next, the 45s. For those who chose the 45s, you're risking $3.90 on the offer to make. If Sony drops to 25, you've got a maximum reward of $16.10. What's the risk to reward ratio there? 4 to 1? Yeah, a little bit better than 4 to 1. So we'll say 4 to 1. All right. So far, both of these have qualified as far as having a good risk to reward ratio. And what's the break even on this trade? If we're buying the 45 puts and we're paying $3.90, 41.10. Okay. 40 puts, risking $2.10 to make $12.90. What's the risk to reward there? 6 to 1. I feel like I'm at the track. Wait, the long shot's coming up, guys. Of course, the long shot won at Belmont, didn't it, this year? Okay, so I'm going to show you something else that was a long shot that actually we were looking at more than just the risk to reward, but I'm going to show you a 24 to 1 risk reward trade that was done earlier this year that actually panned out real nice. And it was actually in London I did this. This was using the FTSE, the FT 100 index. And, for those of you that think, you can only do this in U.S. stocks, you can do it in anything that has options. So I'll show you that as well. The 35s, risk $1 to make 9. Obviously, we know what that is, 9 to 1. And we know also that you got to be at 34 to break even. And the last one was buy the 30s for 40 cents to make $4.60. What are we looking at there? About an 11 to 1. And then you're also seeing the break even there is going to be what? $29.60. All of these are good. There's not a bad trade in here. The question is, it's really the thing is speed. If we all believe that Sony is going to go down, the question is it going to go down by the time frame that we've allotted for these options? So, there's a good saying that, having too much time isn't bad. It might limit the amount of money you can make because it's going to cost a little bit more, but I've never seen anybody take a loser on too much time when it went their way. They just didn't make as much. I want to get into now is that I've shown you a couple of stocks here, and these had some, options that range from, what's a 40-cent option going to cost you if you buy a contract? $40, right? Less than lunch here. Now, if you bought the 50 put, you're going to pay $6.40, so that's $640. So there's a difference there, and that might determine how you're going to handle which option to buy based on your own pocketbook. Okay, but realize the most important thing is in directional trading is the system first and where you expect something to go, and then applying the right strategy. Now, tomorrow we're going to talk about non-directional trades. It's exactly the reverse then. It's the strategy is more important than the actual movement because you don't know where it's going to go. And so we're going to get into that. But I want to stick with directional trading the rest of the day and kind of get some of you out of the... for those of you that have a good directional trading system, guess what you can do? You can take now this object of options and apply it to the system you're using. How many of you are looking for something that works directionally trading? Raise your hand, please. It's got to be more than that or I'm not going to teach this. I will show you what I'm using that's been working for the last several years in up markets and down markets. And like George said, this is the best time to be trading if you have the right if you have the right system to use. It's unbelievable the amount of money you can make. You can make more money in a down market. You can actually make the same amount of money in a down market you can in an up market in 1/3 the time. It's very, very quick. In fact, one of the guys that's actually lives here in San Francisco, I see him at this seminar quite occasionally, and he says, you know what, I can make a lot of money going up, and I can make a lot of money going sideways, and I can make a whole lot of money going down. And I mean, he was poised and ready to fire on this move down. That brings me into the section I want to talk about called vertical spreads. And vertical spreads, what I mean by vertical spreads is we're going to take positions on stocks that have options that may be a little bit more out of your pocketbook, okay? Positions where you can take an options position and further cut the risk by simply financing it by selling another position. So I'm going to use IBM as an example. And what I want to do is let me just review the following risk graphs with you. I had a couple people asking about risk graphs before lunch. I'm going to show the 6 basic risk graphs that George talked about this morning, applying them to IBM as if it were at 100. Then we're going to take this and get a little bit further and actually create some combination graphs, which are going to really cut our risk. All right? Everybody remembers what this graph looks like. Long stock. A lot of you in here hold this risk graph. Maybe not after today. This graph has unlimited risk, it has unlimited return, it has a lot of stress in it, which is why we don't really trade this particular graph. The next one would be a short stock. If you were actually going to take stock to the downside, you know, what you're doing is, let's say IBM's at 100 like it shows here. If you were to sell 100 shares, as the stock dropped down to 0, you're actually making money because you get to buy it back lower than you sold it. All right? Now, how do you actually sell something you don't own? Well, simple. What you do is if you think IBM's going down and you want to sell the stock short, you go to your broker and you tell them you want to short the stock. What they'll then do is they'll either pull it out of their inventory and sell it on your behalf, or they'll go buy it from someone to sell on your behalf. And to close that trade out after you've shorted it means you have to do what to close it? Buy it back. So if you sell it at 100 and you buy it back at 80, you just made a 20-point profit. Now, is the firm going to let you do that for free? No, there's interest rates and on top of commissions, finance charges in order to actually complete that transaction. But that's how the transaction works. It's basically you're borrowing something to sell so you can buy it back later. It's kind of like that day when I borrowed your Viper. Remember? Then I sold it to, you know, only had to steal it back. That would have been an unlimited risk trade. Don't you guys agree? I would have expired worthless. That's right. All right. Yeah, that's what it would have been, the Acapulco trade. I would have got rid of his Viper and I would immediately move to a country that he wouldn't have been able to find me in. All right, long call option. Now this is where, you know, George showed this morning, and the example I have here on the screen again is using IBM. If IBM were at 100, if we were to buy the 100 strike and maybe buy a leap option and pay 20 points for it, that means by the expiration we've got to get to 120 because this graph will deteriorate 20 points if the stock doesn't go above 100 by expiration. Limited risk, unlimited reward. Same thing with a put. It's exactly the opposite. 100, if we bought a put option and paid 20 points for it, it would have to reach 80 by expiration to recapture the 20 points in premium that we spent. See, I think a put option is kind of like car insurance. Okay? If you have a car and you put insurance on it and you crash the car, you're able to go in and do what? Exercise your put option and at least replace the car, okay, or for what the value of it is. It's same with home insurance. If you have a home and something happens to that home, you've got homeowners insurance. People buy insurance for many reasons, but the number one reason, it isn't because they have to. It's because of peace of mind. And so why not have insurance on your stocks as well? Now, you can take this one step further, and this particular option is actually an example of actually making money as the price falls. Now, these are the two we talked about that you don't really want to be doing. Why do people sell options? Because they want to become the insurance salesman, okay? They want to sell the option and receive a premium. All right, now imagine you're an insurance salesman, and you're down in Florida, and you're selling hurricane insurance, and Hurricane Andrew comes through and wipes out the whole town, and you had all the policies, and now you've got to make good on all those policies. That's exactly the same thing as being short a call or a put option, is that you are open-ended as to how much risk that you can attain. Now, think about that for a second. Let's go back to that. How can insurance companies afford to insure South Florida for hurricane insurance? And if that hurricane comes through and knocks everybody out, how do they keep from going out of business? They hedge it. How do they hedge it? They reinsure for a larger amount with a Lloyd's of London or a bigger company, okay, a bigger casualty company, and they create a spread. So they're limited as to how much they can lose. And so that's exactly what we're fixing to do. We're going to hedge our option positions by reinsuring using another strike. Does That's the best way I can explain it to you on how hedging works. So why do we spread options? Lower cost, lower risk, because we can actually reduce our cost by spreading, we can reduce risk by spreading, we can reduce the break-even to expiration by spreading our options. And that slows down our day-to-day fluctuations too, which is what causes a lot of people to run into that stress problem. So by slowing that down, you kind of eliminate the stress. You can think more objectively. All right? So my question when I consider a trade is, what if I'm wrong? If I bought the stock, then I might be in some serious trouble. Like Johnson & Johnson last week. If you own Johnson & Johnson, here's a safety stock, guys, that all of a sudden doesn't look too safe anymore. If you had owned the call options, you wouldn't be feeling so bad because that stock up until last week was a really low, it was a sleeper stock. The options premiums were not that high. Now what has happened? Within a period of one day, what's been low has become high in volatility, and what's been high has become low in price. And so that's completely changed around. So this is what you got to ask yourself. What if I'm wrong? What if a stock drops by 20 points, like Johnson & Johnson? Here's what happens. If stock drops by 20 points, if you own the stock, you lose 20 points. Okay? If you own the at-the-money option, you may only lose 10 points. All right? If you have a spread, you might only lose 5. So options will change value relative to the stock price by no more than the stock price itself. But it could be a lot less, depending on the option you own. Okay? That's referred to as an options delta. And the options delta is basically this. It's the change in the price of the option over the change in the actual stock. If the stock price changes by 20 points and you lose 10 on your option, what's 10 over 20? 50. You lost 50% of the rate of speed that the stock dropped. So guess what your options delta is? 50. And now, if I had a spread on, I'm actually making my delta even less. Because now my entire spread, if my entire spread just lost 5 points, my delta is 25. That means I have 25% of the directional risk as a stock trader does. Now, you've heard the term delta neutral, correct? All right, you know what delta neutral means? That means we have no directional risk compared to a stock trader. We may have other risks involved in the markets. So what we're going to do is with our hedged positions, our vertical spreads, we're going to try to get our deltas down as low as we possibly can, but still have a risk to reward, which is greater than 3 to 1. And that can be done. We can get our delta risk down to a 5 or a 10, meaning that if the stock drops 20 points, we may lose 50 cents or $1. Okay? So these are some examples that by hedging, how you can really curb your risk. So delta really equals directional risk. All it does is it tells me how much is that option going to change basis the stock. That's it. Okay, it's kind of like if you go to Las Vegas, you know that big 6-wheel, that thing that spins and it's got all the money on it, and you put $1 down, on a 1. Well, you'll either make the 1 or you lose the 1. If you put the $1 down on the 20, chances are it's not going to hit, but if it does, you make 20 points. What's the chances that you're going to hit on a 20? 20 to 1 at least. Probably much higher than what we think because of the way that wheel is rigged, but in terms of risk to reward. But you know that the chances are very, very slim. Kind of like an option where if you buy an out-of-the-money option, you know what? You're not going to lose anything more than the price of that out-of-the-money option, but it's going to move much, much slower than the stock is going to move in terms of speed. So what we do is, I say this, if you can't take the directional heat the stock offers, change the risk curve. All right? And this is the risk curve we're going to talk about now is the risk curve of what's called a bull call spread. If you're looking at your blueprint that was handed out to you, I would like you to turn to page 5. Page 5 is bull call spreads, and we've got the Cliff Notes version of the notes you want to be taking on bull call spreads right there. Now, as we move along, I want you to take a look at this example up here. I've got Trader A, Trader B, and Trader C. They're all bullish on the same stock. The only difference is how they attempt to trade this stock. Trader A is going to buy 100 shares of this particular stock at $100 a share. Trader B is going to buy a call option, a 100 call option, and pay 20 points. Trader C is going to buy a spread. I'm going to talk about what a spread is here momentarily, so I know most of you in the room do not know what a spread is unless you've watched videotape number 2 a few times. Then you may not know what a spread is, but you will here shortly. Now, each one's going to pay a different amount of cost. Trader A is going to pay, if you buy 100 shares of stock for 100, what are you going to pay? $10,000 to acquire for those 100 shares of stock at 100, unless you have a margin account that'll be less. Trader B, if Trader B buys a call option for 20 points, what's that going to cost in dollars? $2,000. So significantly less than the 10, but still expensive. Trader 3 decides to buy a spread, and they do what's called the 100-120 bull call spread. That's what BCS stands for. All right? If we did this and we paid 5 points for that entire spread, then that means that we are now spending a debit of how much? 500. So my questions below was, who has the least amount of risk? A, B, or C? C. Who has the greatest reward? A, B, or C? How many of you say A? Raise your hand. How many of you say B? Raise your hand. How many of you say C? How many of you just can't raise your hand at all this afternoon because you're too... Okay. And who just doesn't know, raise their hand. That's fine. I like an honest person. If you don't know, that's fine. You will know here in a moment.